to begin.
Thank you. At this time, we'd like to convene the City Council Finance Committee meeting for Tuesday, June 4th, 2024. Will the clerk please call the roll?
Chair Burt,
Here.
Vice Mayor Lowing,
Here.
Councilman Vinker.
Here.
For the record, 3 present. Thank you.
Great. So before proceeding to our agendized items, we have an opportunity for the public to speak on any item that's not on the agenda. Do we have any speakers?
Yes, we do have 3 speakers. Our first speaker is Cand H.
I think you all know me, Ken Horowitz, longtime resident, about 40-something years. And I'm here to encourage you to finally, after 4 years, to lease room K4 to the Living Wisdom High School. They've been trying to get this room for many, many years, and they've been told, 1, there are no vacancies. 2, we have a waiting list this long. It's not true. It's been vacant for 4 years. And one of the things that you should consider, because later on you're going to talk about the budget, is take a hard look at the financials of Coverly, because there is income there that's not being tapped. And leaving rooms vacant for 4 years is in the neighborhood of hundreds of thousands of dollars. So just wanted you to be aware of that. So what I'd like to see happen is that within the next few weeks, a lease, whoever has the authority in the city to issue a lease to Living Wisdom High School so that they can increase enrollment. And they know when they start school again in the fall that they'll have 2 rooms to serve students. And they can use this time to get the room set up, plan for the different labs that they're planning to hold there. And this will be a win-win for the city and a win-win for our residents. So again, I'd like to encourage you to sign off a lease as soon as possible with Living Wisdom High School. Thank you.
Thank you for joining us. Our next speaker is Eric M.
Yeah, hello. I'd like to also encourage you to rent room K4 to Living Wisdom School. And we believe it'll be financially better for the city. You know, right now, you already have 7, as we see, you have 7 hourly rooms right now that are available at Coverly. That's probably, you know, we don't know the details of how full they are, but my guess is that's probably enough to meet the demand that's already there. Whereas if you rent to us, you have a good tenant that pays on time, and you'll be getting a monthly rent with no administration over cost. You know, I run an Airbnb myself. There's a lot of costs in renting out on an hourly basis to somebody and just in managing that, and you wouldn't have to clean it. There'd be no cleaning fees. So I think financially it'd be better for the city financially to rent to Living Wisdom School. And then as a social priority, it's certainly higher than anything else that would be using the space. You know, we've heard there are a lot of groups that are interested in it. If you look at the groups that are renting from Coverly now, at least full time, you know, there's Acme Education Group, which, you know, my kids went there for a little while, but they're they're a testing service that teaches kids to do drills and stuff, and which is fine. And you know, they're the biggest. They're the biggest ones that Coverly supports right now in terms of space and rent. And then also the Dance Connection is fairly large, which is a very nice social service. But helping our at-risk teens should be the highest priority for our society and for our city. And so we would hope that the city would be a part of that and prioritizing that higher than these other things. I mean, our school has demonstrated that there's a segment of at-risk kids that we can really help out. And we've been doing that, and we've shown success over the last 4 years doing that. And we could help out another 25 next year with this extra room. And then ongoing that would mean an extra 12 to 15 new kids every single year that we could be helping out that won't be helped out if we don't get this room. And that should be a priority in our city, in our society. You know, my kids went to Gunn High School here, fabulous school, but it doesn't meet the needs of all kids. There are some kids that just need a smaller, more personal environment that like a Living Wisdom School can handle and do. So please help us make this available for kids. Thank you.
Thank you. Our next speaker is Keishama K.
Thank you for having me this evening. I'm the director of our high school program. We actually are a TK through 12th grade school, but most of our students in the high school come in at 9th grade and continue with us through the end of high school and then continue on to university. Most of our students have had some kind of difficulty in other educational environments, whether it be public or private, and about a third of them have had serious issues with suicidal ideation, in some cases attempts. And what we're seeing, I've been the director for 5 years. The high school's been open for 7, our elementary and middle school for 30. What we're seeing year after year after year in working with these kids is that they come in and they have layers of difficulty, it's almost like peeling an onion until you get down to the heart of who they are and take away all of the challenges that have been there and all of the protective mechanisms that they've put in place. And they're radiant, they're absolutely magnificent young people, and they just need a space where they can relax and be safe and then start to put their lives back together. We run a fully accredited A through G college preparatory curriculum. But more important than that, I would say, is our how to live education philosophy. We teach them how to be happy, how to be effective, how to have meaningful relationships, and how to know how to face challenges when they go on to their next steps. So we've been functioning in K-5 for the last 6 or 7 years. We started with 6. When I stepped in, we had 11 students and it served us very well. We're now at 23 and we have a growing wait list because we can't serve anymore. We have people locally who want to be here. We also have people from out of the country trying to move to Palo Alto so that their kids can be in the school. We're willing to pay rent. We want to be contributing members of the community center, but we really can't be in an hourly rental situation right now. We are doing that in one of the other rooms, and we move in for an hour, we teach an academic class, and we go back out. But K-5 is our home base, and it holds everything and the children. And we just need more space. K-4, we originally asked for it 4 years ago. So I know we're on that list of however many people multiple times because we've requested it repeatedly. I've been told that we are the only people requesting it consistently. So if there's any way to make just one of the rooms K-4 available, we will be incredibly grateful. Thank you for your consideration.
Thank you, Chair. That concludes public comments.
Great, thank you. And we don't have this agendized tonight, but we've heard a number of comments on this. Can we receive some sort of a staff report explaining the request that this school has had and how that aligns with available spaces at Coverly? Sure.
So just to make sure I understand what the request is to understand how the Living Wisdom's request aligns with Coverly's rental programs.
Yeah, and what prevents us from being able to provide them more space, if
Certainly.
anything.
Okay.
Okay, thank you. Okay, so we'll move now to our regular agenda, and we're going to take item 2 out of order, take that first, which is to accept the June 30th, 2023 actuarial valuation of Palo Alto's retiree healthcare and other post-employment benefits, and recommend to the City Council to approve annual actuarially determined contribution for FY 25 and 26.
I'll introduce it first, Chair, and then I'll hand it over to Doug Pryor. So as you read the title, it relates to our other post-employee benefits, which is our retiree health. We'll first have Doug Pryor present. He's from Foster and Foster, the senior consulting actuaries. And then when he concludes, we'll need some direction and clarification from the committee as to the fiscal 25-26 contributions. And you may say we'll just keep it consistent with the direction from May 21st. But technically, this is the report that we would bring back to you, including all the details. So a couple weeks ago, it was the abbreviated version for the purpose of the budget deliberation. So with that, Doug Pryor will make a brief presentation. So the floor is yours. Thank you, Doug.
Thank you. Good evening. Yeah, so I'm going to kind of run through a very lengthy report, the June 30, 23 actual evaluation report, and just kind of hit on some key items here to cover what's most important. If you have questions as I go along, by all means, ask them, or we'll hopefully have time to at the end. So if you could go to the next slide, please. So I want to just briefly cover what are the benefits we're talking about here. Well, an employee needs to retire directly from the city, elect a medical plan, at which point the city will pay a portion of that retiree's medical premium for their lifetime. Generally, these benefits cover almost the full retiree and dependent premiums. There are a number of kind of layers or tiers here, but that last square bullet, almost all your active employees at this point are in the Group 4 benefit, which requires that the employee work for 5 years with the city and then retire directly from the city. And then you can kind of see the caps there, which vary depending on single, two-party, and family coverage, somewhere between basically $1,000 to $2,400 per month is paid by the city. There's that vesting schedule tacked on top of that, which is that bottom box there, which shows with 10 years of service, retiree would get half of those caps, and at 20 years the full amounts. So if we go to the next slide, you can kind of see historically what the payments. Oh, I'm sorry. We have one more on kind of backup. So why do we do the valuation? So the purpose here is really there's two purposes: plan funding and accounting. What we're talking about tonight is the plan funding. They're required to be valuations every 2 years. We last did a June 30, 2021 valuation. So this June 30, 2023 valuation is going to cover recommended contributions for the next 2 fiscal years. The contributions will go to the trust the city has set up with the CRBT. That's the CalPERS OPEB trust that was established back in 2008. And the actual determined contribution is really a payment on the value of benefits accruing for active employees in the year, that normal cost, and then a payment on that unfunded liability to pay that off, which we're currently amortizing over 20 years. There's also accounting information that will be generated from this valuation under GASB 75, but that's not going to be covered tonight. If you go to the next slide, please. So historically, the benefits under the plan that have been paid to retirees is amount to millions of dollars. So you can see for 2008, way back then, it was under $5 million for that year. I'm looking at the dark green bars to come to 2023, and that number had grown to a little over $11 million. Those are the cash benefits, what we refer to as cash benefits, which are the benefits I was just talking about on the initial slide. There's also this theoretical implied subsidy payment, which is the lighter green on top, which also is a kind of requirement to be included. You can see the magnitude of those numbers. That was required to be included commencing with fiscal year 15. So you can see there's none of the lighter green bars there before 2015. But the idea here with pre-funding on a very basic level is to have the money set aside in the trust so that all these payments here are made to former employees of the city. And the idea would be have those payments made from the trust with money that's been set aside while employees were working for the city. So if you go to the next slide, just briefly in terms of participants in the plan over the years, you can see total participants there grown from in 2007, a little over 1,600 to the current study, a little over 1,900 participants. The colored bars there are the blue are the retirees and the purple are active employees. So you can see, similar to the growth in the benefit payments, you can see the growth in the retiree counts. The percentage there also show that you have a much higher percentage today of retired employees, 53%, than you did back in 2007 at 38%, right? So you have a lot of more former employees out there collecting benefits that need to be paid. So with respect to the trust, if you go to the next slide, you're with the CRBT strategy. They provide 3 strategies. So we always like to remind clients of just the 3 basic options that are there. You're invested in strategy 1, which is by far the most popular of the strategies. And is also most similar to the pension fund, and really kind of reflects the long-term nature of the benefits, right? So it's the most aggressive. As you can see, it results in the highest expected return, but it's also the most kind of traditional strategy to be invested in for a long-term benefit obligation like this. So if you go to the next slide, we kind of look at performance on the assets. There, thank you. Since the previous study. So these amounts are in thousands of dollars. Really, we have 2 years that have transpired since the previous study. And what you see there, if you go from the upper left, beginning of last year, of 21-22, 164 million in assets. And you roll forward to June 30, 23, and that had dropped to 156 million. So, what's primarily driving that is that last row. What you see there is the return for 22 was negative 13.5%. For fiscal year 23, it bounced back a bit at 6.4%. Now, keep in mind, we're assuming that long-term 6.25% return. So when you look at these 2 years and you combine them, really, the return was, negative roughly 7% for the 2 years versus what we had assumed, which is close to, 13.5%. So there's a significant asset loss in the current valuation, which is going to bump up that unfunded liability a bit. There's nothing unique here to your plan. These losses have been seen, across the board on pensions and on OPEB. And by the way, since we're mentioning the other strategies, if you look at that 21-22 year, it mattered very little which strategy you were in, 1, 2, or 3. You were negative 11, 12, 13% roughly, whatever strategy you were in for the return for that year. So if you go to the next slide, we do have kind of to put a little more historical perspective on the returns. What you see here are the market value returns going back to 2009. So you can see the volatility here. Another thing to point out is look at that peak in the third data point from the right for 2021, 27.5% return. So when we had prepared the previous study, we're coming off of that great news, right? And so things were looking much better than they do today. What we've seen since then are those far right data points that we just talked about, the negative return and overall for 22, and overall negative return for the 2 years. So what does all this translate to in terms of a funded status? If you go to the next slide here, it says historical funded status. Let me maybe explain what the graphic is. The height of each bar is the actual accrued liability. The blue bar, whether it's light or dark blue, the combination of the blues is the retiree liability, and the green is the liability for active employees. The red line are the assets. And then what you see in bold is the funded ratio. What's the ratio of assets to actual accrued liability? So here's kind of the first indication of the impact that the new valuation had reflecting the negative return. You can see the funded status, June 30, 21, or funded ratio was 67%. And as of the current valuation, 56%. What doesn't show up here, and I probably should have put in data points, but let me just, since we're looking at this, you can kind of eyeball it, but it's probably hard to do. What's the unfunded liability? June 30, 21, that unfunded liability was about $80 million. He had about a $244 million accrued liability, assets of $164 million, so $80 million unfunded. We look at the June 30, 23 analysis, and that 80 million has now jumped up to $120 million, okay? In terms of what really drove that, we kind of talked about the assets, but that's, of course, not the only thing going on when we do a new valuation. If you go to the next slide, what you see here is, significant changes on that unfunded liability. So it increased by about $45 million more than expected. And what you see here are just kind of the key drivers. We did revise our assumption on where we anticipate future premiums to go in the future. That increased the accrued liability by $17 million. Investment loss was about $34 million. And then you have an offset for contributions actually higher than expected. So you have all of those as being factors coming in, but keep in mind that a liability increases the unfunded, and investment loss increases the unfunded. So they're both really kind of going the wrong way, unfortunately, for this valuation. What does that mean in terms of actual determined contributions? That's on slide 10. So each valuation covers a couple of fiscal years. These numbers are also in thousands of dollars. What you see here, if you look at that bottom row, the second column under the 21 valuations for the current year, that actual determined contribution was $11.7 million. You come to 24-25 under the current study, and that's jumped up to about $16.4 million. So the bigger increase there is that unfunded liability amortization payment there, right? Which you see on the second to last row, that bumped up from about 5.3 million to an $8.8 million amount is the primary driver. There was some increase also for the normal cost calculation too. So both of those resulted in an overall increase to the $16.4 million. I should mention that unfunded liability amortization is paying off. As I mentioned, June 30, 23, you have about $120 million unfunded. That $8.8 million in the second row, second from last column, is a 20-year payment on that unfunded. So if everything went as expected, of course, a million things are going to change over the next 20 years, but if everything went as expected, the unfunded liability would be paid off and be zero in 20 years, 20 years from now. So that's the actual determined contributions. To go to the next slide, we have then kind of how this projects out, with the blue kind of representing historical amounts. These are in millions. The green representing our projection. So I think just a couple notes on this slide. What you see is that dip in 22, 23, right? That was that following that 27.5% return on the investments. You have that drop down for the 2 years covered by that valuation. And then we kind of pop back up, right? And we kind of pop back up to where we were, more in line with where we were, back 4 years ago than 2 years ago. The other thing is the projection there, as you can see, when you get to the green to the right, unfunded expected, as I said, to be paid off 20 years out. So 43, 44, that would be paid off. And the contribution would then drop down to the normal cost. You always have the value of benefits accruing for active employees as kind of an ongoing cost. So that's always a component. So that's, where you've kind of been, where we project the contributions to be in the future. The following slide then shows kind of what that translates to in terms of an unfunded liability. If you could go forward one slide. Thank you. So here the green bars are the unfunded liability, kind of indicated by the amounts on the left axis. And so you can see there's this little over 120 million unfunded projected June 30, 2025, and then you can see that being paid off over the next 20 years, that those bars come down over time as unfunded is paid off. If you want to look at this in terms of a funded ratio, that's the purple line with really the indicators there on the right side of the axis. You can see you get to the 100% funded status over that 20-year period. So that's kind of what we're calling the baseline actual determined contribution. And then I know that the city has looked at some optional funding in the past. So the following remaining slides kind of cover that. If you go to the next slide, everything we've been looking at here in terms of that actual determined contribution based on the 6.25% discount rate and 20-year amortization of the unfunded liability. This to just give you an option, kind of consistent with something that's been looked at in previous valuations. Says, well, what if you set that actual determined contribution on a more conservative basis? So assumed investment earnings are lower in the future rather than 6.25% annual return, 5.75%, and then pay off that unfunded liability on a shorter schedule, pay it off over 13 years instead of the 20 years we've been using. What the second bullet there says is, okay, that would mean that the $16.4 million actual determined contribution would increase to, for next year, would increase to about $22 million. That would be the ultimate impact of moving to a contribution on that basis. The following slide shows the those contributions kind of just stacked for the 2 years. The baseline, again, are the numbers we've been looking at. These are in thousands of dollars. So you see there for this next fiscal year, the baseline is 16.4. This optional amount would be about 22 million. So it would be additional 5.6 million for next year. And for fiscal year 26, another 5.7 million for that year. In terms of how this then projects out for the optional contribution, if you go to the following slide, you can see the figures here, and we have a graphic of this in the last slide that's after this one. But if you look at this, this is showing kind of the details of the optional contribution. So, keep in mind, benefits are paid to retirees, right? And so that is you've not taken benefit payments out of the trust historically, certainly not the last 2 years. So you look at fiscal year 25, what that is saying is that we anticipate about the second from the far left column there, the cash benefit payments. We expect about 12.8 million. These are in thousands of dollars, 12.8 million in cash benefit payments. Another 2.7 million in these implied subsidy payments. So when you combine those, what you're paying to retirees outside of the trust is, about 15.5 million. So if you pay that money outside of the trust, the additional amount to pre-fund this optional actual determined contribution would be that trust pre-funding column, 6.4 million for fiscal year 25, followed by about 6.1 million in fiscal year 26. And then you could kind of see how everything projects out here. The ADC is structured to be kind of a level percent of payroll. So if you see the column third from far right, you see the ADC is about 17.2% of payroll in every year, okay? And you can see the unfunded liability projection there in the second from far right column. If you go to the very last slide here, we kind of have the previous one that we had been looking at with the optional funding one layered on. So let me kind of try to get your bearings on what the colors are here. The green is the unfunded liability for the base contribution, base analysis with the 6.25% discount rate. The purple is then the funded status projection, with the right-hand side being the funded ratio projection, with the scale being on the right-hand side. And then the red are those numbers replaced if you did the optional funding. Now, the optional funding here, what we're assuming is, all right, let's be more conservative with that discount rate. So the liability, if you look at that first data point far right, the liability of unfunded liability, I'm sorry, of about 120 million, because the discount rate's lower, the liability actually is $20 million higher. So it's $140 million. You can see that, though, to the extent you then amortize and pay that off over the 13-year period, that comes down relatively quickly. And you can also see that funded ratio gets to 100%, much sooner, of course, right, in 13 years. Certainly that's the expectation. This is how this would project out. So that's a quick run through of the valuation results and kind of an optional contribution structure. I wanted to then in there and open up to see if there's any questions.
So Chair, to clarify, because Doug provided two scenarios, the baseline and then the optional. What happened 2 weeks ago on May 21st was committee moved on the optional with the 2-year phase-in. So we're seeking confirmation of that direction tonight, but just wanted to clarify that.
Oh, so I hadn't appreciated that. I don't think it was explained to us at the time that it was an optional versus.
So from an actuarial perspective, he'll call it optional. To us, that aligns with our policy. So if we want to be aligned with our policy, which is the 13-year amortization, we would be moving forward. Then can you put that slide number 13 up for us? Yes. So this slide indicates the policy, right? The 5.7% discount rate payoff in 13 years. The cost differential is 22 million versus 16.4. That's the extra 5 million or so. So if you go to the next slide, there's the differential. So from an actuarial perspective, Doug will call it optional. From our local perspective, that option aligns with council's policy that was approved. Okay, so what we're looking for today is confirmation of what happened on the 21st, which is the 2-year phase-in, where we take 1.65 million additional in fiscal 25 in the proposed budget. And then in 25-26, we would then take the full impact in the general fund and all the other funds.
So
Okay.
what we did is get us up to 22 million.
Yes.
Now,
As a phase-in. So
Pardon me?
Paul
Yeah,
was going to
phase.
correct, as a phase-in. So in fiscal 25, the proposed year, we will do half of that, but in 25-26, we'll carry that full amount going forward. But what Doug is calling optional aligns with our policy.
And just to be clear, your 2023 and 2024 budget and contributions have been in alignment with that policy. So any deviation and understanding that there's a significant increase, that's why we're phasing. The policy allows for some flexibility.
Well, before returning to us for questions, do we have any members of the public who want to speak?
Chair, we do not have any requests to
Okay.
speak on this item.
Back to colleagues, questions? Yeah.
Yeah, I have a couple. You said that was a short presentation, it was short and fast. So I just had a couple questions on I think, let's see, this might be. Well, we got to 120 million unfunded liability from 80 pretty quickly. Can you put up that slide and tell us kind of what happened there?
Yeah, on I guess slide 8, although it didn't show the 120 million Again, the red line or the assets and the height of the bar is the accrued liability. So if you take the difference between the red and the top of the bar there for 21, it was for June 30, 2021, that number is 80 million. And then we go to 23, you can kind of visually see the gap is bigger, right? But if you had the numbers, I'm saying
But
that
you're going too fast again. Are we talking about the 630-21 bar?
right, 630-21.
So where's the 80 million there?
So the 80 million, so the height of the
67.
bar, yeah, the height of the bar is $244 million. Okay, you can
Right.
see it's almost hitting 250, right? So that number is 244 million. The red for that data point, the assets, which are 164 million. So the difference between the bar and the assets, the liability and the assets that's the 120 million as of June 30th, 21.
Okay.
Okay. And then when you go to June 30, 23, the top of that bar there is $277 million. The assets there, the red is hard to, can't really tell, but that's 157 million roughly. So the difference is 120 million in an unfunded liability. So,
And the combined factors there are what?
yeah, so on the following slide 9, if you could page down, this is really, you've got about a $40 million increase in the liability. And what you see here, the primary drivers are an assumption change of 17 million.
Okay.
Yeah, and then the investment loss about 34 million, offset by some contributions a little higher. When you kind of knit all that out, that's really why the unfunded liability is growing.
Okay, I didn't do the math fast enough because I didn't see that 17 million
Sorry, yeah.
premiums increased. So that was that question. And what was the unfunded liability before slide 12? Because you just went from, I think, last year.
For slide 12.
So you started in 25 showing that it's 120 some million. But what did that look like? I'm just trying to figure out if we improved already or we're still. I mean, I understand it's slightly off subject for.
Yeah,
Right.
that one is most informative, that one
Okay.
right there.
That's the
Right.
one we're already looking at. Okay.
Yeah, so the height of the bar indicates the liability, so you can see how it fluctuates, but it's a major jump. And the relationship between the height of the bar and the red line, which is the asset, is, I think, most informative.
So the broader question, which you shouldn't answer until we have all this conversation here, but is if we should do something more than these two things that we're doing of splitting up these 2 years because of this deficit, or we think that we're going to, the market's going to jump back, the premiums aren't going to go down, and we know that. So is there any other action that we should prudently take, or you think we're okay for 2 years and we look at it? That'd be a question I just put on the table for now. Thank you.
Vicky?
Thank you. Just sort of picking up on that. Yeah, it's so fascinating to see the 6.25% investment returns target and then to look at like this chart on slide 7. The swing is incredible. And I know we had a pandemic, but you look back at 08, 09 and we had, I guess we had a market crash, but there's been a lot of noise around that expected return rate, that orange line in the middle, a lot of variance. So it's hard to feel too confident about much of anything looking at that chart. So looking forward, Ed, it's a little tricky to know exactly where things are going to go. I did want to make just one comment. None of us have a crystal ball, and I certainly don't on what I'm about to say, but I did want to share just a little bit of information. One of the factors in the staff report was the health premiums, the higher than projected healthcare premiums. And the text afterwards says it's not known whether the recent change in healthcare premiums will be ongoing or an anomaly due to the significant governmental support of healthcare costs over the past 2 years. Because it is unknown whether these changes are the beginning of a trend or merely a temporary anomaly, This report models short-term significant rises in healthcare costs in alignment with inflation. So I have a comment and a question, because it says significant rises in alignment with inflation. Now, if it was just in alignment with inflation, I don't know that I would call that significant rises. I think the problem in our state and our country has been that healthcare costs have risen significantly ahead of inflation over the last, decades. So maybe someone can first explain that statement, and then I want to add a little background on healthcare costs.
I don't know if it's easier to untease that statement or maybe ask Doug if you can explain in the model, what are the assumptions in healthcare premiums for us to understand?
Thank you.
Yeah, so I mean, first of all, we're assuming premiums are going to increase, and not only that they're going to increase, but well above inflation rate. So we have built into the model in the near term somewhere around 8% annual increases in the premiums, and the model kind of scales that down over time. The reality is that while 8% is kind of our short-term expectation, if that really can't continue for the next 50 years as we project this out, right? Because if we have, 3% even inflation over that period, but medical premiums are going up by 8%, half of us are going to be doctors and nurses 50 years from now, right? So we don't know what we'll give, but something will give. And what the model is doing is saying we need to go from where we are today to lower increases a long ways down the road. And so that's all built into the model. And as I said, in the near term, roughly, depending on pre-Medicare, post-Medicare plans, whatnot, somewhere around an 8% near-term increases in the premiums.
Okay, that's really helpful. And I'm not suggesting that be changed because it seems prudent for now. What I will add is you're absolutely right that 8% would be unsustainable going forward. And I happen to have worked on a healthcare roundtable for the state a couple years ago, where we recommended that cost targets for affordability be put into place by the state. Thereafter, it went to the legislature, it passed, and the governor signed it. And there is an Office of Healthcare Affordability that's relatively new in the state now. And just a couple months ago, for the first time ever, they did what we recommended they do, which was to set cost targets. And those are for all forms of healthcare. It's for physician practice groups, hospitals, and insurers. So it should include premiums, and it's well below 8%. They set them every year. I can't remember, somewhere in the range of 3 to 5%. That doesn't mean a particular insurer can't go over it in a particular year, but there are ramifications for that. But the main thing is that I'm optimistic that your model will be very conservative. So I just wanted to share that.
Okay. Thank you. So if I could add one thing, the big drivers here are, of course, how much your premiums increase in the future, and then the investment return. And we were looking at that volatility of the returns over the period in that chart. If you average those out, it's about a 6.4% return. So while there's a lot of volatility there, and the caveat, past performance is not a predictor of future performance, historically about 6.4% return for what that's worth. There is the volatility issue to deal with, certainly.
Yeah, thank you. I did note the 6.4. It just feels like there's a lot of, I was calling noise, you're calling volatility, but but I do appreciate that. I just want to add that really helpful, both the written report and these graphs. I actually don't have a lot of questions because I think you did a good job of helping educate us. So thank you.
Great. So just a couple follow-ups. The 6.4 is averaged over how many trailing years?
I forget what that chart went back to. 0809. Is that, I think, when it went back to?
Slide number 8, please.
Oh, I see it. Oh, yeah, it goes all the way to 0809. So
So
so we, within those long-term trends, we'll get some big disruptions. But what that's captured, just kind of, why did it go to 0809, not 0708, for instance?
Good question. I don't know if that's, let's see, what year did that, we had that in an early slide. Let me see. The trust was initiated in March of '08. So I think all that's going on there is that
The year that it was
you have
initiated.
assets for '07, '08, but they're in there for a short period of time, and that might have been a crazy return that wasn't really reflective of anything. So we started in the first full year, '08, '09.
Okay, so that captures this one of the severe anomalous years, like 2021 was an anomalous spike, and 21-22 was an anomalous crash. But that one in 08-09 is kind of even skewing. If we were to merely look at trailing 10 years, we'd have an even higher than 6.4. I don't know how much higher, but somewhat higher. And so I think that really on a kind of an objective basis, that's the 6.4 is probably conservative based on trailing 10 years or trailing 20.
Yeah.
Yeah.
Yeah, so actually, right, the helps to be remote. So I've got it in a spreadsheet. I can tell you, right, the last 10 years average was 7.2%. So you're right, it was higher over that period.
Okay. And we had, when we set the 5.75, we did that in what year?
I'm sorry, what was the question, Chair?
When did we set the 5.75, the optional?
In the last valuation, so 2024, 23, 22.
Okay.
In 2022, and that was in alignment with the pension policy adjustments that were made, I want to say maybe 18 months prior to that.
And we had deliberately said that we thought that CalPERS maybe needed to adjust theirs downward, and we were going to kind of anticipate a downward trend. When I look at this over kind of the trailing 10 years, it's making me question whether that's a bit overly conservative, but just to bear that in mind. I'm not advocating that we change it, but just how we look at whether it's adequate or not. And then if the projected premium costs that Vicky was just talking about, how far out do we have it at, like the 8% before it trails downward as you were describing?
Well, it almost immediately there's minor reductions, maybe, can't remember now if we have a couple years at 8, but then it's maybe dropping 25 basis points or so gradually over a long time frame.
Okay.
And just if we could move back to that investment return assumption, is one of those things that try to convey a lot of information briefly. That 6.25% long-term return assumption is not based on historical returns. What that's based on is a survey that our firm did on 8 independent outside investment advisors on what their beliefs were on future returns at that point in time. So, certainly they're going to look a little bit to the past, but I would say it's more of a kind of a perspective outlook on where returns are going to be.
Yep, I recall that. I guess one of the questions too is that we didn't get the 2-year actuarial until just recently, but based upon I assume that we had the 20/21. Oh no, excuse me, the 21-22 numbers we had previously. Is that correct? Or we just got them as a 2-year package?
2 years. So Doug, we do the actuarials every 2 years. So this contains the 2023 data. And I believe the last report Foster & Foster did contain the 2021 data point. Is that correct?
That's right.
So we didn't know the 21/22 numbers until just now?
Are you talking about the actuals or are you talking about what the valuation had
The
projected?
actuals, the returns.
We did know, obviously some of them. When we did this 2 years ago, we actually did do more conservative in terms of our financial planning, anticipating that we would have a bad year in 2022. Because you could see the market wasn't doing well by April or May of that time. We didn't assume conservative enough. So I think what we had assumed was we put in some factor for wage growth. We also put in, I think we did a 0% return. Clearly that was
Right.
insufficient. Had we not done those, we would have actually seen an even bigger jump. But they were just insufficient from a planning perspective. These are actuarial calculations. So to your point, Chair, we don't rerun them. So we made those kind of slight variations back then to help us try and hedge for what we were anticipating would be some volatility. They were not sufficient.
Okay. And just from the near term expectations, the current fiscal year that's about to end, do kind of what is what do the experts think the typical rates of return are going to be for this fiscal year without a precise number?
Well, no, I can give you a fairly precise number because the CRBT reports returns, I believe, on a quarterly or monthly basis, must be monthly, the April 30 year-to-date returns. So from that valuation date of June 30, 23 through the end of April, they were about 6.1% return for the year.
Annualized?
Not annualized.
Oh, just
Yeah.
to that point
Right.
through 3/4 of the year.
Yeah, right. So they're probably slightly ahead of the 6.25 year to date.
Okay, thank you. All right. So any other questions or motion?
I have a slight update.
Yeah.
It's good news. I checked actually on the healthcare cost targets, and just on April 24th is when they were issued. And it's the state, the Office of Healthcare Affordability's board approved a statewide healthcare spending target of 3%, phased in over 3 years, 3.5% in 2025 and 26, 3.2% in 27 and 28. I guess phased in over 3 phases, but 5 years, and 3% for 29 and beyond. So hopefully we're in good shape.
Let me just ask, is that state healthcare target part of how we're anticipating future healthcare costs?
No, I mean I'm not sure what those numbers are. Maybe that's is that for state budgeting purposes? Is that what those numbers are?
No, it's a brand new thing. So we'll see how fast there's compliance, and there are penalty things built into this whole new scheme. And so I don't expect the industry will stop immediately. But the idea is to bring literally healthcare bills, whether they're hospitals, physicians, and insurers, that people pay in line with inflation, as we were talking before, so that healthcare costs don't go up disproportionately to income for California families. But I think it'll take some time for them to actually hit these targets, but they're trying to get it down in line with that target over time.
But right now, that's just an ask from the government.
Well, it's an ask with penalties. If you don't make it, they can haul you in before the board, and they can ask for a performance improvement plan, and they can assess penalties. So they're hoping that hospitals and providers and insurers will comply. So there's a stick if you don't, but it's not, they're not setting an absolute one, because there might be a good reason some year that some hospital can't comply, seismic upgrades or whatever. Sorry.
Seems like there's more leverage with the hospitals than there is with the insurance companies.
It applies to insurance companies equally.
I know, but I'm saying that you might have better results with the hospitals, but I don't know, just
I
speculating.
think the insurance companies might have less reason to not comply, and if they're slapped with penalties, which they can be under this scheme, hopefully they will.
So there are consequences for the insurance companies as well.
Yeah, the last iteration of this that I saw, it's subject to the board's discretion, and I assume, initially they'll probably be a little soft on it, but yes, the insurance companies are similarly subject to these rules as the providers are.
Well, that's pretty interesting, and that would be a significant change. And I think we need to assume that even if they don't hit those numbers, it's going to have an impact. They'll more likely be close to them than status quo.
Yeah, and I mean, I should say that was the proposal we took. That was what the assembly member who brought the bill had in his bill, and that's what I believe went through. I should double check and make sure, because I'm sort of doing this on the fly when I saw it in the staff report. But the recommendation and the intent was always to have insurers covered as well. I can double check that.
Yeah, well, I think going forward, that'll be an important thing to make sure is incorporated in the actuarial updates. It's pretty encouraging between us being a little conservative on the rate of return and being conservatively high on the what now may be the cost increases.
I think I have an answer for that because the director of the office, Elizabeth Landsberg, said, as California's spending target phases in, we expect to see consumer premiums, deductibles, and copays to become more affordable. So I have to say, I'm pretty proud of that work. So that's why I'm so played in on it. I think it could make a big difference to families, but also to budgets like ours, public budgets. So hopefully it'll happen.
Chair, can I check in? Earlier, committee member Lowing asked for staff's opinion, but to hold off until we heard more.
Sure.
Wanted to check in if that was a question to staff.
Well, to staff and to colleagues,
Oh, okay.
relative to the numbers that are in front of us. But yeah, I think you should start.
Okay, super. Maybe we have the last chart, please, Vin. That one. I think this is illustrative because one, it kind of illustrates the policy and how it is going to help us get ahead of the original plan, right? The red shows how we are going to hit that funded level sooner. Consequently, we also have to contribute more as well. So I think the policy as it stands has merits. Recognizing there are volatilities, but when it comes to actuarial studies, they're modeling for 20 years, right? So we need to kind of take the short-term volatility as it stands. You made the suggestion, stay the course for a couple years and look at it. I think that's a good one. One, because we have a policy, and two is, as we saw already, tweaks in this have significant financial impact. So we don't necessarily want to overreact and then consequently have to curb services or priorities in other areas that we may desire. Right. So I think seeing this slide is encouraging, and it also gives us an opportunity every 2 years to come back and see the financial impacts. Right now, it looks like, in 13 years, we would hit that fully funded level, even based on these current assumptions.
And I'll just add that this is based upon a 5.75 rate of return, right? Investment. Is that correct?
The red line, right? The red portion, correct, Doug?
That's right.
Yeah. And trailing 10 years is 7.2%, and it's based upon an 8% increase then in a few years starting to trickle down. But it sounds like in 5 years, we'd still be at 7% and
On healthcare.
correct.
Yeah.
Yeah. That's what we're talking about.
Yeah, I didn't think you mentioned the word healthcare, so I just want to
Oh, that's
clarify.
all about, right?
What I was talking about, but I think this is, I understand what you're saying.
Yeah, and that there are multiple components. So 7% on the component, which is the health premium, not necessarily 7% on the investment return, because didn't want to conflate the different factors. But yes, we
Right.
agree.
One's basically the dollars in and the other is the expense. Yeah. So I think based on what we're hearing, one or both of those factors are actually conservatively high.
Yeah, and then the stating the obvious, which is sometimes worthwhile doing. The other way to kind of head this off in the future is not to have as many fixed head count. So that's just part of management of the city. And then you also don't get as many projects done.
Yeah, well, if you have the unfunded retiree amount, it's actually another way to look at this is what's going to be the value of those dollars in those future years. And as a percentage of our budget, or our projected population, those numbers are even less consequential rather than more consequential.
Question. If we affirm this 2-year phase-in of the ADC that we talked about last year, the adjust, I don't know if I'm saying all the right words, but you know, and we have what may be a couple of different conservative assumptions. In a few years, if we're way ahead of the game, can we adjust?
So Doug, maybe you can explain how the actuarial reports are recalibrated every 2 years. So if assets improve, I imagine whatever residual amortization years there are, that outlook would be recalculated, right?
That's right. Every 2 years, this is revisited in detail, including, you know, we'll take a look at the, you know, the impact of the state's approach to see if we think that's going to, you know, impact our healthcare trend assumption. I don't look. I honestly don't know a lot about it. It's very glad to hear the news. I'm maybe a little bit of a pessimist myself, so we'll wait to see. I'm hopeful, but not certain, you know, that it's going to have a big impact. But we would certainly, that's one of the things we would revisit in a few years. I guess the other thing I would say is coming back to the investment return assumption. You know, that again, that is our 6.25 going forward is our best estimate for where returns will be in the future. Where I wouldn't. From our perspective, we don't view that as being conservative. I think I would probably understand a little more the medical trend may be being considered a little conservative, although we're not trying to be there. You know, I guess what I'm trying to say is, you know, the investment return assumption, I think, is really kind of our best estimate. And to answer, there is a question. Yes, every 2 years. This is all kind of rehashed in detail where we not only look at these assumptions and reflect the investment return, but we collect data, see how many retirees are around, what their plans are enrolled in, all of that detail every 2 years and make updates appropriately.
Yeah, well, thank you for explaining that cycle. I think that's what I was hoping the answer was going to be, something like that, because it seems to me that while I may be an optimist and, you know, expect for the healthcare thing to improve, in a couple of years, we'll know if it's beginning to get traction and if we're going to adjust. And then I'm fine with leaving it as is now. I mean, I support this recommendation, and others may have more to say.
I do as well. I just want to clarify. You just said the 6.25, but aren't we using the 5.75?
Well, yes, for that budget amount, but I'm thinking this is kind of the line to draw here is that's kind of why we have the 6.25, what we're calling the baseline, is kind of that's our, in some ways, best estimate. The 5.25, 5.75 that we call the optional, but is kind of built into the city's policy, is we think of that as having a little bit of conservatism built into it.
Got it. That's what I thought.
Yeah.
Okay. So, yeah, so that's where I was comparing the 7.2 trailing 10 years to compared to the 6.25, but it's actually to the 5.75. Okay. All right. Are we ready for a motion?
Sure. Well, I'll move the staff recommendation.
Second.
Okay. So that's to accept the FY23 actuarial and approve the funding associated with it for FY25 and 26.
Yeah.
Using a 2-year phase in.
Right.
All right.
Yep.
All in favor?
Aye.
Aye.
All right. That passes unanimously. Thank you.
Thank you, Doug.
I wanted you to take credit
Thanks,
for your healthcare work, Vicky. I want you to take credit for your healthcare work. So you got to make the motion.
I,
Oh, that was kind.
Vicky, I heard about this from Vicky for several years that she was working on it, so, yeah.
But yeah, and it went into the legislature's hands, so I. Fingers crossed.
Okay. All right. So now we're going to go to item 1, which is recommendation to council adopt a resolution amending the gas utility long-term plan and associated items. I won't read them all.
Good evening, Chair Burt. council
Evening,
members. So we are bringing back our long-term hedging program back to you. As if you remember, council approved a 1-year hedging program that was to basically buy some insurance for this 1-year period of time, which ends in November of this coming year. So tonight we have actually some 3 options. We have an option from staff as well as options that came back from the UAC. And each of those have differences that we will talk about during the presentation. And you'll see that there's some large impacts to that large hedging program. And then there's actually one in there that really has no cost to it. And I think that depending on how, when the UAC put the one option in there for not looking at any type of increase, just opening up the $5 was basically because of the cost that we've already established on the percentage for the gas with the of the 12.5%. So their thought was really not wanting to add too much more to that, but that was one of their thought processes. But you do have later this evening, you have an option to be talking about that gas transfer and item number 4 tonight. So depending on what you would like to do tonight as we go through this presentation, but I caution you that the decisions that we make tonight, and if we're going to add some monies into for a reserve, this rate stabilization, the increase of that 12.5% will go up a certain amount depending on what options that you choose. So I wanted to make sure that you're all aware of that. So with that, I have Jason Hong with me. He's our senior resource planner that did a lot of work on this report. And then I think Carla Daly is online, I believe.
Yes, I'm here.
Thank you. So Carla Daly's with us as well. So with that, I'm going to go ahead and turn it over to Jason.
You want to turn it over to me, Jason?
Yeah, go for it.
Great, thank you. Yeah, Jason and I do have a presentation for you this evening, and thank you so much for having us here, Chair Byrd and council members, and thank you to Director Batchelor for setting the stage for what we are going to present to you this evening. As Director Batchelor said, we do have a staff proposal on the table. We also have the 2 UAC recommendations that they preferred over staff's proposal. We chose not to go back and change staff's proposal, but to just sort of lay out all the options for you to consider. From staff's perspective, we're fairly agnostic between the different alternatives that you could consider recommending to council. Next slide, please. So just as some quick review, back before 2012, we had a fairly robust hedging program where we locked in most of our gas at fixed prices over kind of a laddered period of 36 months, and that resulted in relative rate stability. In 2012, council changed the commodity purchasing strategy and the commodity rate setting strategy to a monthly market price based pass-through with a maximum commodity charge in that rate schedule. And that was really a result of a legal requirement that only council has the ability to set rates. And so we were advised by our legal counsel that we couldn't have an open-ended pass-through rate on the books. We needed to have some cap on that rate. We chose $2 a therm, which was quite high compared to any prices we had ever seen. And we stayed below those levels until the winter of 2022-23. Next slide, please. So during that winter, I'm sure will recall that we saw some really high prices in November, which is kind of the first winter month in what is considered the winter months in a gas year. We started noticing that prices were rising. We started a communication campaign to our customers, letting them know that we were expecting some higher prices over the winter, encouraging them to conserve to help keep bills down. And in the last council meeting of that calendar year, we asked council to double that maximum commodity charge from $2 per therm to $4 per therm, doubling it, thinking, okay, this is a really high number. We'll be sure to, actual prices will surely come in lower than that. Lo and behold, January 2023, the market price was nearly $5 a therm. And so because we were unable to pass through the full cost of gas for that month, we ended up pulling a little bit shy of $2 million out of reserves to cover the portion of the price increase that was not covered through customer commodity rates. Next slide, please. This picture is always helpful to tell the story of what happened that winter. You can see that creeping up and then that very dramatic spike in January of 2023. And then the nearly as impressive drop back down to pre-spike levels that we have seen in the months since January of 2023. Next slide, please. I'd like to turn it over to Jason to talk about the strategy that we've had in place this past winter and the proposal that staff has put on the table for this evening.
Thanks, Carla. Good evening. Good to be speaking with you all again. A lot has happened within a year. So I want to go into the background a little bit more and just talk about how we did the cap winter price strategy last winter and then what we're looking for this upcoming winter. So as Carla mentioned, prices declined again, and state and federal investigations were opened into what occurred during the winter of 22-23. However, due to the extreme price spike, high customer bills, complaints, and wanting to mitigate the risk of another unexpected price spike, council approved in September 2023 a cap price winter gas purchasing strategy for the gas year, November 2023 to October 2024. So probably 3 more months of that. November 2023, October 20. Okay. It ends in October 2024. Right. So yeah, cool. There you go. So the cap price winter gas purchasing strategy involved continuing to buy gas and setting the customer gas commodity charges at prices tied to the monthly market index, but also at the same time buying price caps for the December through February months. So this capped the price paid to $2 per therm for a portion of the city's expected gas needs. As part of the approval of the strategy, council approved a maximum 15 cents per therm impact to the gas commodity charge. That translates to about 7.6% increase in annual bill to buy these price caps. And price caps, effectively, they were working as an insurance policy to limit the impact of potential repeat high winter prices. Okay, so that was the approval of the strategy. When it came time for buying the price caps, we were only able to purchase $2 per therm price caps for only about half of our expected load for December 2023, January 2024 and February 2024 months, because the availability of the suppliers at the time was low, and this was also within the cost constraints of what council approved. So the total cost of the price caps actually ended up being $1.5 million. So what was projected was close to $3 million. So we came about at half of that. Spread out over an entire year, an adder of 5.5 cents per therm was applied to the gas commodity charge starting November 2023 and then ending once again this October 2024. This represents about $1.80 per month on a typical residential bill, or about a 2.8% increase. What actually happened during this past winter? Well, nothing too crazy. So we're thankful for that. But the monthly market index price actually remained under $2 per therm. It still has remained under $2 per therm. So we didn't make use of the price caps we purchased, but we basically paid the insurance premiums and didn't enact on the policy. Next slide, please. Okay, so when council was approving the cap price strategy, council also directed staff to look at other ways for managing price spikes for the longer term beyond the current gas year, which ends this October. So we explored alternatives, and we are now proposing a new recommendation, which is to fund a reserve to self-insure against future short-term price spikes. Now, I'm going to talk about our recommendation, and then there were two more that came out from the UAC, and we'll discuss that later on. But with our initial recommendation, we wanted to maintain the practice of purchasing gas based on the monthly market index. An adder would still be included in the gas commodity charge for gas price mitigation purposes. But instead of using the funds from the adder to buy price caps from another supplier and losing that insurance premium if prices are below the cap, the funds would be collected and accrue in the gas rate stabilization reserve. And the intent would be to use these funds from the reserve to offset potential future short-term price spikes. So we would be holding on to the money and using it when we needed to. Self-insurance, there you go. For this reserve proposal, staff recommends an adder of 10.3 cents per therm. So that's an estimated increase of 5.2% to the annual bill. Based on this, the numbers work out that that's an estimated 2.8 million that would accumulate each year, with a total balance of 11.3 million after 4 years. And this is if no funds are withdrawn to mitigate any kind of price spikes in interim after 4 years. Okay, this is actually in line. So this 10.3 cents per therm and the 5.2% increase is actually in line with the maximum adder that was approved by council last year to buy the price caps. Now, we ended up buying half of it, so we didn't use all of it, but we were approved to go up to that full 5.2% increase, or 10.3 cents per therm. Actually, a little bit over that. Okay. If we go with this, staff expects that as of November 2028, the rate mitigation adder would have raised $11.3 million in total. So this would be enough to maintain the gas commodity charge at $2 per therm for a single month, even if market index prices spike to $5 per therm for that month. Okay, which that was the highest price during the 2022-23 winter period. It actually was close to $5 per therm. Now, there's also another side to this. As part of this proposal, as the funds accumulate and there are certain levels of protection, we also expect to recommend reducing the customer maximum gas commodity charge from the current $4 per therm back to the $2 per therm level. And so we would be doing that throughout the years. After 2 years, it would be $3.50 per therm. After 3 years, it would be $2.75 per therm. And then after 4 years, after we get that full $11.3 million, we would then be back to $2 per therm. And so that would be roughly around fiscal year 2029. Next slide, please. Okay. Okay, levels of market price protection. Okay, so this table shows the reduction of the maximum gas commodity charge over 4 years. So you can see in the left-hand column, as well as the maximum market index price spikes and corresponding number of months, either 1, 2, or 3 months, that would be protected against by the reserve funds after accumulation of 1 through 8 years of the adder. This assumes that the adder isn't kept in place and there are no fund withdrawals throughout the period. So taking a closer look, if you look at the highlighted year, year 4, after 4 years, if we collected that $11.8 million in reserves after 4 years and also reduced the max charge to $2 at that time, then the amount of funding would offset a price spike of up to $5 per therm for 1 month. So we're going to the right, $3.50 per therm for 2 months, and then $3 per therm for 3 months. Okay. Our initial proposal is for a 4-year term We expect a return with the recommendation to either continue, eliminate, or make changes to the adder. But the adder would ultimately be part of the review as part of the annual rate setting for the utility. So we would have opportunities to look at what do we want to do with the adder? If we want to change it or do something else with it. Once again, our recommendation though is for a reserve balance of 11.3 million. So variations would provide more or less protection. For example, a reserve balance larger than 11.3 million would provide more protection against higher price spikes or a longer duration of the spike. You can see protection up to, if you look at after the 4 years after the highlighted row, if you look at after 5 years, you can see that the price protection is up to $5.75 per therm. After 5 years, $6.50 per therm after 6 years, and so on and so on. And this would be keeping the $2 per therm max commodity charge in place, $2 after 4 years. So continuing on and on into perpetuity. But on this chart, it shows up to 8 years. Next slide, please. The customer bill impact. Okay, so this shows the impact of the proposed 10.3 cents per therm adder. It equates to an estimated increase of 5.2% on the median monthly residential bill. The estimated increase will be 5.6% for the winter months, which are classified as November through March, and then 4.6% for the summer bill months, which are the remaining months, April through October. This 5.2% increase over the year, it's worth mentioning is that this increase is actually in comparison to going back to the procurement strategy before the caps. So it's not on top of the caps. It's if we to go back to doing nothing again as far as the hedging and then adding these reserve adders funds in, it would be an increase of 5.2%. And this adder also is less than the impact of 15 cents per therm that was approved for the caps. So that was a 7.6% increase on the median monthly bill. This is a 5.2% increase. And remember, this cap purchasing strategy is only approved through October 2024. So if we want to do something, then we're looking at doing something for beyond October 2024.
Can you clarify how that compares to what's in the current budget?
What's inside the current budget as far as
based on gas rates and percentage increase?
So I think you mentioned the 12. Yeah, so we're adding 5.2 to it off of this recommendation on top of that. That's right.
That was a question that I had, and my question I wrote down was, does that mean that 12.5 plus 5.2 is a 17.7% increase under this proposal?
That's right.
That is correct.
Okay.
That is correct.
Yes.
That's right. Okay. Next slide, please. All right. So I'll try to explain this slide. This is we talked about different variations of the policy, and there actually are a good amount of different variations that can occur with the adder and how much you want to try to collect. But try to paint a picture of a few different scenarios and what the accumulation of the reserve funds would be if we had different adders. So once again, the recommendation that we are looking for or that we're trying to put forth here is 10.3 cents as an adder to get to a total collection of 11.3 million after 4 years. So that's the first column. You'll see the $11.3 million there after 4 years. If you look at the top row, these are different adders for comparison and how many years it would take to reach that 11.3 million. So with a 9-cent adder, it would take closer to 5 years, so between 4 and 5 years. With the 6-cent adder, it would take 7 years. Yep. And then with the 3-cent adder, it would take 14 years to collect 11.3 million.
Sorry to interrupt, but what was our previous reserve amount before we drained it in 22, 23?
We took about $2 million out of reserves to deal with the price spike.
So we didn't have a rate stabilization reserve, so it was not even established.
So this 11.3 is all new.
Yes.
Yes.
So we would create, as you asked us, to create this other reserve that would just hold just the rate stabilization.
Okay, thanks.
Is now an okay time to ask a related question to that? It's, so I get how you're building the reserve.
Uh-huh.
What triggers it coming out? If it goes above $2 a therm, or when? And then you stop getting the adder and you start going the other way in terms of covering customer costs?
Yeah, so that's a good question. We still have a few more slides and it'll kind of dive into that.
Sorry.
But yeah, let me go ahead and actually at this time I think I'm going back to Carla to kind of talk about the different alternatives, and then we'll talk about the different variations and then talk about how we anticipate withdrawing from the fund. Carla?
Sure. Next slide, please. And yeah, good question. So in coming up with this proposal, as in response to council's direction, we tried to anchor on some previous known numbers. How much council was comfortable spending for this past winter, what the cap price was before the spike. And so that's sort of how we developed this proposal. But with that said, there's nothing magic about those numbers. And, basically 3 levers that could be pulled depending on what direction council wanted to go. The first one is that, the reserve could be, if we're not wanting to build up so much money in the reserve, we can have a higher or a lower adder. It would take longer to get to that larger number, or we would just not collect as much money. The collection period could be longer or shorter. The maximum commodity charge could be higher or lower. And so to your question, Councilmember Vinker, depending on where that commodity cap was, if the price went over that cap, that's when we would draw on this reserve to, pay for the shortcoming and what we weren't collecting from customers. Now, that said, if we end up drawing on that reserve during the time period that we were planning on building it up, we would need to come back to council and say, well, we were at $3 million. We took $2 million out of it. What do you want to do? Do you want to bump up the adder? Do you want to abandon the strategy? Do you want to extend the period of time that we're collecting that for? What have you? So there would have to be another decision point if we ended up needing the money before we planned or hoped to need it. The other option out there is to replicate what we did for this winter. That was, that product is not super available out on the market, as Jason was saying. And so we just don't know what we can buy until we go out to buy it. We don't know how much they'll be for us. We don't know how much it will cost. And whether you use it or not, it's a sunk cost. So we feel like that's a pretty big negative for that strategy. We could also go back to the strategy that was in place with no drama for more than 10 years, which is just to pass through the market price with no short-term price spike mitigation. That, as when we get to the UAC alternatives, that was their preferred alternative, with a slight modification to raise that maximum commodity price up a bit more from its current $4 to $5 in order to protect the utility. Next slide, please. So I'm not going to go through this whole slide, but at its core, any changes to our purchasing strategy and how we set commodity rates really does lie in this document called the Gas Utility Long-Term Plan. And so any changes to the current strategy would need to be reflected in that document. This is just the wording that aligns with the staff proposal that's on the table, but it could change to reflect whatever direction you would like to go. Next slide, please. And likewise, we have another document called the Gas Utility Reserves Management Practices. If we're going to propose the staff proposal to council. There are some minor changes that would need to be made to that document as well. So they're shown here. Next slide, please. And so, yes, back to the UAC recommendation. We did present this proposal to them at their May meeting, and they had two preferred alternatives. One that I just talked about, which is raising the gas commodity charge maximum gas commodity charge to $5 a therm. Don't put an adder on, don't do any hedging. That was their preference. But they also came up with a second alternative, which was to maintain that maximum gas commodity charge at $4 and reduce the adder from 10 cents down to 6 cents, from 4 years down to 3 years, and for staff to return for review in 2 years. Next slide, please. We are currently scheduled for council at the first meeting after the summer break, I believe August 5th. And any council approved strategy would be implemented beginning in October 2024 for the gas year that begins November 2024. That is the conclusion of our presentation. We're happy to take more questions.
Great, thanks. First, do we have any members of the public who want to speak?
Chair, we do not have any requests to speak.
Okay, colleagues? Ed?
Yeah, I'll jump in. I had the benefit of seeing the dress rehearsal for this at the Utilities Advisory Commission, so, which is why their presentation is so good. They practice it so much. It's very strong presentation of a lot of complications. Did you do a calculation of what the 6 cent adder does instead of the 10.5?
As far as the
Yeah, I think, Jason, you pretty much have that on one of the slides, right?
yeah, if you look at slide 9, then if you can go back there.
Oh, yeah.
Okay, so the 6 cent adder is the the fourth column.
And then they said
Left.
4 years, so that is around $6.5 million.
Yeah, no, I meant, I want to know the percentage.
Oh, the percentage.
Ah. Well, it's about, let's see. Can you do that in your head, Jason?
As far as the bill increase,
Yes.
yeah, it'd be about 3%.
Yeah, I was gonna say.
Yep.
High twos. or something.
3.2 for the winter and 2.7 for the summer.
And just if staff could clarify, council and the committee have this kind of July rate increase in their heads. And this is talking about the kind of the current insurance policy sunsetting in October, which has a cost to it, and then this coming on at that time. So can you help articulate kind of how that number that you just referenced, the 3% crosswalks between a July increase versus the 12.5% July increase that we currently have, and what would be the additional increase felt in November?
Yes. So they're additive. So any hedging strategy that costs any money would be in addition to the 12.5% increase that is will be proposed on June 17th to council.
Yeah, so overall, I think that the way we did it last year turned out to be pretty expensive insurance. And I'm not sure we should pursue that one. Plus, it was hard to find anyway, which ended up helping us because we couldn't buy as much as we wanted. So
Sure.
we
One way to
actually,
look at it,
good
yep.
job, we saved $1.5 million. So I think we should sort of rule that out. We could also this year decide that there's no way in God's green earth or whatever the phrase is, that this is going to happen again because it was a one-off and we're probably covered for this year and we don't really have to worry about it. So I think that is an option for us to decide. One of my thoughts about this adder, as it was discussed at UAC and reading it again in this document, is, I'm not sure that, 11 million is really necessary in all these scenarios. So I was interested in getting the sort of total down, and therefore not essentially taxing the consumers in advance because they're paying the insurance policy. So the 0.6 helps in that regard because it takes it down to 6.5 and it keeps the rate down. And it gives us some adder. And I think we do it for 3 years and stop so we don't have this big extra reserve there. So that, in essence, the backup recommendation for UAC, I think, has the most appeal. Or we could say this is good and we'll wait a year. So that's kind of where I come out on it. And the obvious advantage of having the adder is we're, at least even after the first year, we got a little bit of money to spend to bail folks out for that, 1 month. So that's kind of where I'm kind of netting it out for myself.
Vicky, did you want?
Sure. Yeah, I think I'm very much in line with what Ed described. It seems like there's kind of the two issues of, are we gonna do the adder? If so, how much, how fast? And then what's the cap that triggers the you know what I'm trying to say. Anyway, I was sort of struck by the comment I think Ms. Daly made about, most of the last decade or so, it's been no drama, right? But we did have that spike. So I do like the idea of an adder and a reserve. But because of the no drama, if we have to pull the trigger before we hit 11.3 million, not that big of a deal, because I'm not sure that the 11.3 is the right number. Could you talk a little bit more, maybe you did, or just repeat for me how you came up with the 11.3 as the bogey for the reserve?
Right. So I initially took like the $5 per therm that we got to during the winter 2023. I try to replicate a scenario where we would be protected against that $5 per therm. And so I kind of backed out of that $5 per therm in our max commodity charge to see how much we need to accumulate after 4 years. And I took a horizon of 5 years. So we're 1 year removed. I took a horizon of 5 years because I didn't think that we would be hitting that mark every year.
Right.
And I can't tell when we'll hit it in next time. So I did just take a crack at saying, okay, 5 years is a horizon that is pretty conservative. I don't think it's going to happen within 5 years, but I don't know for sure. So,
Right.
But that's, I backed into that amount.
And $5 for a couple of months, or how long?
For 1 month,
1 month.
so in this scenario here, I think it's a previous slide, you'll see that if we, or maybe, let me look at what slide it is. It'll give you a better picture of this. Okay, it's slide 7. So the one before this. So if you look at after year 4, it'd be a protection of up to $5 for 1 month, $3.50 for 2 months, and then $3 for 3 months.
So thinking about the cap, I mean, is that something else that we should make some kind of recommendation on now? Because those feel very different. We've talked about the $2, I think, in the initial staff proposal. This is all the way up to $5. It's more than double. The impact on our customers is significant depending on whether we hit 2, 3, 4, or 5. And I guess for me, if it's up at 5, doesn't feel all that protective because it's pretty darn high. If it's down at 2, I mean, it's not that bad when you hit 2. So I don't know what the right number is, but the 3 or 3.5, maybe even 4 feels a little better to me than either the 2 or the 5. And I'm curious what my colleagues think. But I think that's a significant question, because we also don't want to, I don't know that we want to completely insulate gas users from the market, because we have some policies around that we don't necessarily want to incentivize them to keep using it. But on the other hand, we don't want to be punitive. So I guess for me, a somewhat moderate approach that builds up a margin, a reserve, If we have to tap it before the 11 million, I'm not too worried about that because I don't think this is going to happen that often either. I'd like it to be not super high. And I just on that, so my last question is, we talked about the 17.7 that would come from the staff recommendation. If we did UAC alternative 1, and I know Ed just asked about this, the 6 cent per therm, I thought we said that was a 3% add. So does that mean 15.5 as opposed to 17.7? That feels a little better too, because 17.7 is a pretty big number. So, and then the last alternative or the second alternative from UIC, no adder. I mean, I do kind of like the idea of self-insuring, and I do think that's better than going to the market and buying the caps that you throw away if you don't use. So I guess I'm sort of zeroing in on UIC alternative 1 generally, but I would like to hear from my colleagues on what that cap.
Could I add just a couple of thoughts as you're getting ready to deliberate that? Just 3 quick points. Maybe this is stating the obvious, but a really low maximum commodity charge and a low adder are not, those don't work well together. You know, we either need a lot of money to cover a spike above a low maximum charge, or, you know, obviously if it's the other direction, we're fine. But so just throw that out there, that these 3 levers are related to each other. So as you're considering that, keep that in mind. One other point I wanted to make is the price of the insurance from last winter will expire at the end of October. So as far as what customers are feeling, we don't consider that as part of the base case. We ignored that, as Jason said, in determining these increases. But technically, there's one charge going away and potentially another charge coming in. So there's a little bit of a netting out of those if you did decide to put an adder on the bill. And then the last comment I wanted to make was that the UAC did have a discussion about the general philosophical desire to pass gas price signals through to customers, and a consideration for low-income customers, and they were interested in ways to protect low-income customers. I have some questions into legal about that, and so I don't have an answer to share with you tonight on that front, but it was an interesting part of their discussion. So thank you. Apologize for jumping in.
And I think the UAC was more in favor of the latter. Is that correct? They really felt like if you're going to use gas, pay for it, and whatever it costs, it costs. We're not
Yes.
gouging the pricing.
Yes.
So let me just, as first couple clarifying questions. Sorry if I kind of missed them. So the current rates that we adopted, do they assume the expiration of the cap? The
Yes.
add-up for that?
Yes, they do.
You know?
Yes.
Yes.
Okay. And in the 22-23, we drew down 2 million to mitigate, but the impact was 2 million plus 11.3 or 11.3 total. Was the impact on ratepayers?
So the impact on the ratepayers were
Even more than
that, but we drew down because we could only go to the $4 mark. So there was that dollar mark. So that $1 that we could have passed through was about almost $2 million.
I see. Okay, so it cost us about 2 million to mitigate that $1. Okay. When we think about this volatility, we still don't know what caused it, but we see what happens when major global events have a disruption one place, and then you think things have stabilized, and then 6 or 12 months later, somehow it seems to have had a ripple impact, whether it's from people figured out how to use that disruption to gouge, or whether there's some more legitimate reason. We may find this out in the future, but the market disruption certainly followed the disruption in Russian supply, right? And we've seen, interestingly, that we're not only back stable, but we're now down to levels that we haven't seen since mid 2021, and falling. And what we've seen in the global gas market, which, we have the US market and then the Western market that's a subset in its own supposed set of circumstances, and yet there seems to be some ripple impact. That here we've had a reduction, or at least a disruption, in global supplies from Russia, and yet we're down below 2021 levels. That's an interesting phenomenon. We don't know what that means going forward, but it's kind of suggestive that the global market has figured things out, and that the overall supply for gas is back at or exceeding the demand. Different markets will have different impacts, but at the highest level, that makes me more comfortable to see this trend that we've had. And none of us knew in, spring of 2023, how much volatility are we going to have going forward? And now we're starting to get some indication that it's not likely that we're going to have that kind of a disruption again, and that the market seems able to address it. And for all those reasons, I'm inclined to, first, I think if we're going to have insurance, I like the self-insurance, but I'm not sure that we need to create as much of a reserve as we're talking about, nor place as low of a max commodity charge as we were talking about. So if you've run several different scenarios, but say if we put a $3 max commodity charge, and we spread that, achieving our reserve over a little longer time frame, what does that do for these rate increases? Do we have any idea? So that I'm not sure that you have a spreadsheet that you can just crunch those numbers on, or
yeah, can we kind of extrapolate somewhere? I would say we wouldn't be able to lower the maximum commodity charge to $3 right off the bat. But we could
right.
Yes.
So if we did that over time, we got to the $3 over time.
Right.
And we'd be gambling that we wouldn't have the disruption too quickly that
Right.
would necessitate using that full reserve.
Right.
I guess, just thinking if we went to 3, I mean, if $1 cost us 2, so drop it, we'll say down from 4 to 3, that's $4 million. So we know that.
How long would it take us to get 4 million?
Right. So I mean, if you left it even with this at the 6 cents at the $4 at the 6 cent portion to get 5 million, you're looking at 3 years, according to this graph.
Which is exactly the recommendation for UAC.
Correct.
Yeah, they kept their commodity at $4.
Yeah.
And we would probably have to leave it there for a little bit. I mean, maybe it's only a 3-year deal, and then maybe what we do is we bring it back and go back to the original 2, or leave it at 3.
Yeah, and this whole philosophical question, how much of a spike would we try to insulate the ratepayers? And they wouldn't be happy if it went from 60 cents to $3. But it's about half of the spike we saw. And I think kind of philosophically, that's roughly a good balance of what we can do. And part of it is that we, nobody saw it coming. And what education we do to the ratepayers to say, here's what we're doing. And we'll mitigate, if this ever happens again, we're mitigating more than we did before, but we can't fully mitigate it.
Right.
So I'm kind of inclined along those lines. Then the second question is, how many years would we want to take to get to that level? And I'm concerned that we've got some big rate increases this year. And I don't want to do much to add to that if it's avoidable. So I'd be inclined to spread that accumulation of the reserve over maybe 4 years and to put a max charge of $3. And I'd be kind of curious what that would mean in terms of a rate increase. This rate increase would kick in October or November. Is that when it would happen?
Yes.
Yeah.
Well, we know that, so I guess it all depends on what, how many cents do you want to add? So I mean, if we were at 6, that equaled 3. If you went to 3 cents, it would be basically 1.5.
Yeah.
Which then would take it to 14%, a 14% increase to the ratepayers. And going back to that chart.
Well, it wouldn't be all that now, right? It would be through 5/12 of the year is when it would kick in.
Right. But then years, if you would like to have this for 3 or 4 years.
It would be on top of whatever we have.
So in the future, as you reset your rates, remember that 1.5 has to go first, and then whatever that it would be is to continue on. And I think to get us back to, the chart.
Slide 9.
Slide 9.
Slide 9. So where's slide 9?
It's about after 3 years on the 6 cents.
No, 3 cents.
Oh, 3 cents. Yeah, you're
So we're
looking
back to
at
almost
after 6 years.
6 years, 5 years, 6 years, yeah. So if you wanted to get to the 5 mark, we're gonna be looking at.
Or I thought we were talking about, did we say 4 million if we were going to be twice the 2 million that we absorbed from reserves in 23?
Yeah, it'd be 4, but I was just saying, if you wanted to go to 5, but if we go to 4, you could get then to what, 5 years?
Yeah.
5 years
At 3 cents.
at 3 cents.
I'd be
And you would
inclined.
have a 3 cap.
Mhm. Yeah,
And Chair, just, this took me a long time to figure out in working with the utilities team, so thank you for the utilities team walking me through this. Remember, you are in, right now, the proposal shows that your rate would increase in July, that say 12.5%. And what we're talking about is this adder, right? Coming on in November. You also have your price cap coming off in October. So you're gonna see your rates go up the 12.5% in July. The price cap is gonna fall off in theory in October. That's 5 cents. And then you're also same time gonna be adding the adder
of 3 cents.
of 3 cents. So you actually
Okay,
see
well,
a
that was
net.
what I was asking about earlier.
Yeah.
Yeah, I thought you said that was
So-
baked into the budget.
No.
No, so this is why it took
Okay.
me a lot of time with the team.
Okay, well, then that's better yet.
Yeah, so
Yeah,
I just want
so
to make
that
sure the committee
basically-
understands.
Basically, we're looking at under this scenario of a 3 cent, we'd be looking at a 2 cent. What's the adder adding?
5 cents.
5. A
2 cents
2 cent,
ish.
approximately 2
5.5.
cent decline,
Fine,
2.5 cent decline
right,
come November.
yes.
Okay.
And a 3%, 3 cent increase then, which is about the same.
Well, I guess here's a question. If we're going to make this decision, do we, why don't we just level it out over the year and not have that July increase as much as it was, and we just say we have one rate increase over the course of the year rather than go up and down. And let me just say, from a consumer perspective, they're more sensitive to the up than the down.
Right.
Yeah, I think I hear exactly what you're saying, Chair. We'd have to go back and look at that as staff to figure out what that blended rate is,
Yeah,
because that
that's
price
ridiculous.
cap, we can't get rid of that sooner than October. So we have to pay that price cap for July, August, September, October. So we know we've got that at that cost. And so anyway, we would need to do some machinations to figure out what a blended July rate would be to mitigate those
Yep.
volatilities.
Yeah, I mean, I would also just point out that this is something customers don't see on their bills. It's not a line item on the bill. It's embedded in the commodity charge, which is
Mhm.
bouncing around all over the place every month. And so that's why we usually like to really keep the commodity part of the discussion separate from the distribution rate increase discussion and the financial plan. There's always a fundamental assumption in that gas financial plan that it's ignoring commodity costs.
So if we didn't even it out, customers would see some drop in their commodity price right as they're turning on their winter heaters. And
yeah, assuming that the price stayed the same from month to month, which
yeah,
Yeah,
It's
well,
like-
so the winter, the prices will probably go up from the levels they are right now in the summer. I'm talking about the commodity charge itself without the adder. And so,
has that been the,
Yeah, it may self-modulate on its
Yeah.
own, just from how the customer is gonna feel it and see it. And I think what Carla has identified astutely is, you know, and the confusion is around, right, how we're changing the cost of the commodity through these longer term purchasing strategies versus our base rate. And, you know, when we're talking about the utility rates and the July increase, that's our base distribution. And so, you know, right now you have an influx or just a crossroads where we've got both kind of messing around. And so I think from an administrative perspective, I suspect utilities would say it's easier for us to keep them separate, let the 5 cents fall off and let the adder come on. So it's,
I get, and
So-
yeah, I'm probably okay with that. Just that whole notion of whether commodities tend to go up in the winter. I thought that was really in part because the industry banks certain amounts of gas in anticipation of increased demand in the winter. And do they guess right? And as I look at this,
Right.
this 5-year trend, not a clear winter increase. Some years, yes, some years, no. And I just, my memory is that, yeah, they're guessing.
They're guessing.
And do they guess right or guess wrong? And that influences it. Yeah.
Yes.
Okay. And those are people paid a lot of money to guess.
Yes.
Okay. All right. So are we good with a recommendation then of the 3 cent and phased in over 5 years to get to 4 million in the reserve?
And ultimately dropping the maximum commodity charge to $3.
$3.
Yes.
And staff
the
has
third
have
part.
some leeway in laying that out across the 5 years so that we can kind of look at those numbers a little closer.
So tonight, are you looking for a direction versus an action?
We are looking for an action and would take the finance committee's recommended action and change the staff report for council in August to reflect that.
And are you okay with what yeah, I'm always hesitant to, here it comes to finance committee, what the heck do we know? And it's gone through UAC already. They tried to flesh things out. Are you okay with this?
I think,
Dean?
I mean, I think.
Kick it upstairs?
Yeah. Yeah, exactly. So, I think the thing is that knowing where our rates are today, I think that, this makes some sense. I mean, there's no reason why we couldn't bring this back in 2 years if it doesn't look like we're gaining enough money and, I mean, if it stays like it did, then over 5 years is going to be fine for us. So I think that we can live with this at 3 cents, 1.5% increase, $3 cap on a 5-year deal. And if we had to use some of the dollars, we would definitely come back to council then and say, we're gonna have to go at a higher rate. And then maybe at that point, rates will be a little bit lower that we could jump it up. So we could live with this.
So then I'll move that we put a $3 cap with a 3 cent adder phased over 5 years to get to approximately a $4 million reserve. Is that the right way to put it?
Can I ask for clarification that the $3 cap would not go into effect
Oh.
immediately?
Yes, an
Yep.
eventual $3 cap upon would it only be there on year 5 or would it be there sooner?
So the way I structured, and I can just speak about the proposal that we had at hand, was that we accumulated some funds first for protection over a certain amount of years, and then we dropped the maximum commodity charge. So in this scenario, it is important to know whether we're looking at dropping that after a full collection of the lower adder after 5 years, so that, we've collected a good amount of money, or at least $5 million, and then we can drop it to 3 afterwards.
So let me
use it then.
let me put one other thing out there. If we're kind of putting ourselves in a little bit of a jeopardy if we should have a spike in year 1 or year 2.
That's right,
We don't have enough
yes.
reserve.
That's
Right.
correct.
Yeah.
If we kept the rate steady that our current for the first couple of years, our current adder is the 6 cents or 5? Sorry.
5.5.
5.5.
So say we just kept it at 5.5 from November forward for the next 2 years, and then drop it as we accumulate the reserve.
Yeah, that's better.
Does that make
That's good.
sense?
Yeah. Well,
Do you need do you need the cap to be higher and drop too? Or can you make the $3 cap if we do that?
I don't think it would hit $3.
I don't either. That's why I'm thinking maybe we could start with a $4 cap and then drop it.
Yes, Jason, if we stayed at the 5% though, that's gonna add on to the 12.
That's right. So our current max is $4, but if we're keeping the 5.5 cents,
Maybe
then it would be a
17, 18,
2.8% increase,
2 point.
3% increase on top of the 12.5. So it'd be
but then 12.5 goes down after we get that.
Yeah. So what I think I'm hearing, if I'm hearing the committee correctly, what you're wrestling with is how fast do you establish the reserve in concert with how quick you can pull the price cap from the current 4% down. And
$4.
I'm sorry, $4. Thank you.
Yeah.
And so what I think I'm hearing the committee try and wrestle with is what's the right phasing of those two? Do we want a higher adder in the near term so we can then lower the max price sooner? Versus a more longer term phase? What the committee could choose, if ultimately your goal is in, say, 5 years to have a reserve and a $3 price cap, simply make that the recommendation and let staff come up with what the phasing could look like.
With us saying that we would, as of November, simply continue with the 5.5
Right,
cent
right,
surcharge, but it going to self-insurance.
right.
Right.
But give us the bookends, right? You start in
I'm
November,
good with
we're
that.
at
Yeah,
that,
okay.
and then I think
Right.
Director Batchelor, you and your team can figure out the actual kind of 5-year projected phasing.
Can I just ask a question? So if the, this chart, this 6 cents, that's the 3%. If we don't drop the 2.5% off, I think we keep it there, right? That's what we're talking about.
Right.
right?
We stay at
Okay,
5.5.
so that's pretty close. It's not quite that third column, 6 cents, but it's pretty close. So, after year one, in that one, we already have 1.6, which is pretty close to the 2 million we need for the $4 cap. Right? So what I'm wondering is, if we do what you're posing, which I'm on board with, which is to kind of stay the course, we're pretty much at that $4 cap pretty fast, like almost in year one.
Well, and I think that's why the UAC recommended the 6,
Yeah.
because at their 3-year period of time, you're at that $5 million mark.
So if we just.
But, oh no, I'm sorry, go ahead.
Go ahead.
No, that's fine.
I was just philosophically, I think 6 to 5.5, I think it'd be we would prefer not to have even another
Yeah.
mid-year increase,
Yeah, no,
even if it's small.
I'm
right?
agreeing with that. I was just trying to use this not to
No, I
suggest we do
understand.
6 cents, but to suggest that your suggestion is
I
good.
understood you, yeah.
Yep.
Okay, so then my motion would be to, as of November, continue with the 5.5 cent surcharge, but have that go into a self-insurance. And with the aim of getting to approximately a $4 million reserve. And
5 years.
pardon me?
In 5 years.
Whenever.
Yeah, it's gonna happen sooner if we do that. So just as long as it takes to get to the 4 million. Is there another component we need to?
I thought, if I heard correctly from the chair, you had a desire to pull down that adder in the out years as soon as you were able to drop your price max to $3. Or did you, I mean, that's
Yeah.
at the committee's
Well, that,
discretion.
aren't those, yeah, and yeah, to drop it once we get to a price max of $3. And I'm just kind of looking at that scenario and it's basically, yeah, we're in. So we'll just do it that way and let you guys figure out what that means.
And I would ask one, rather than a reserve target, it's a little easier to have it be a time that the adder is in place, because it's difficult to hit reserve balances exactly. So like a 5.5 cent adder in place for 2 years or 3 years, kind of.
Yeah, that's okay. Well, let's go ahead and put it in for 3 years and then you can always come back with an adjustment. In year 2 or whatever. Okay. That good with the seconder?
Yep.
All right. Everybody clear enough? Don't need to restate it? Okay. All in favor? Aye. Well done.
Thank you.
Just for the record,
Yeah.
that's gonna be instead of that would probably be about 15%.
15%, so 12.5 plus, yeah,
Less than-
roughly
Okay,
less than 3, yeah, that's about right, yeah. Yeah,
great.
looks like 15, yeah.
Okay, thank you.
We'll try to beat 15.
Yeah, try to beat 15, but yeah. Okay.
Sorry, maybe I'm misunderstanding.
I'll-
We're
So,
right now.
Oh, but we dropped the 2.5%.
exactly. So
Ah.
Vicky is correct, Councilmember Vinker is correct in that your base rate is gonna go up 15%. However, by November. However, your customers are gonna feel a decrease in their commodity cost because you're shifting away from having that price.
Right, so we want to
So,
frame it
Yeah.
to the customers that there's not an additional increase, that we have these, we tend to say, this is
Understood.
one category, this is another, but we
That's-
care about, we're not further increasing their costs.
Yeah.
yep.
Thank you.
Understood.
Just wanted to clarify that. Thank you.
Okay,
Thank you
Yay.
so much to all the staff that worked so hard on this.
Thank you.
Thank you
Discussion.
for the discussion.
good, thank you. We're gonna take about a 5-minute break, and then go on to item 3. so we're going to reconvene our finance committee, and the next item is to accept the fiscal year 2024 third quarter financial status report. Welcome.
Good evening, Chair Burt, members of the Finance Committee. My name is Christine Paras, Assistant Director of Administrative Services. I'm here to introduce our Finance Manager, Rosalind Fernando, who will be conducting the presentation. We also have online a number of staff, including Taran Narayan, our Treasury Debt and Investments Manager, to answer any questions you might have. So, Rosalind, go ahead.
Thank you, Christine. Good evening, Finance Committee. As mentioned by Christine, tonight we are here to present the fiscal year 2024 third quarter financial report. We will be focusing mainly on the general fund and enterprise funds. Please note that the balances to be presented are unaudited balances. Overall, general fund revenues and expenditures are tracking within the budget, and it is in alignment of the historical trend. On the table, the second column, it's the 164 million. This is the fiscal year 2024 third quarter year to date. And if you compare that actuals with the adjusted budget of 247.5, we are tracking at 66.2%. Which is comparable from prior year. And if you compare also the actuals to the prior year of the same period, there is an increase of 13.9 million or 9.2% increase. And the increase is mainly due to the major taxes, including property tax, TOT, and documentary transfer tax. We saw also an increase in permits, license, and other fees. This is mainly due to the surge of the new business permits or construction permits rather. And we could also see an increase in the business tax of about 2.6 million, which was just implemented in the current fiscal year. Next slide, please. For general fund expenditures, the actuals is 180 million. And if you compare this with adjusted budget of 285.3, we are tracking at 63.1%. However, if you include the encumbrances, meaning actual plus encumbrances, we are tracking at 69.7%. The calculation of this is on the attachment A of the packet. Going back to the actuals, 180 million, if you compare this with the third quarter prior year, 145.9 million, there is an increase of 34.2 million, or 23.4%. The increase is mainly due to the salaries and benefits, contract services, and general expenses. Next slide, please. This is the general fund stabilization reserve. When we presented last year, the actual as of June 30, 2023 was 61.5 million. As of third quarter for fiscal year 2024, it is projected that it will end at 57 million. This is equivalent to 21.2% of the fiscal year 2024 adopted general fund budgeted expenses. There's a surplus of 3.1 million compared to the council 20% target of 53.9 million. Please note that the 57 million is pending for any budget amendment ordinances to be forwarded and approved by the council before June 30, 2024. And you could also refer to the fiscal year 2025 proposed budget for BSR recommendation. Next slide, please. Enterprise funds change in net position, or this is the result of the operation. For the third quarter for fiscal year 2024, overall for the enterprise funds, there is a net income of 51 million compared to prior year of 20.5 million. There is an increase of 30.5 million or 149%. The increase is mainly due from the electric fund, wastewater treatment, and airport fund. For the electric fund, the overall increase is due to the increase in the operating revenue and decrease in operating cost. Increase in operating revenue is a result of an increase in base rate and consumption, while decrease in operating cost is due to the decrease in commodity purchases due to the improved hydroelectric generation cost. While the wastewater treatment, there is an increase of 5.7 million. This is mainly or primarily due to the revenue increase from the partners that is driven by the advanced billing of the capital activity. Although there is a positive change in net position for this fund, this is already restricted in capital assets. While for the airport fund, the increase is mainly from the federal grants from Federal Aviation Administration and State of California for various airport project. There is no recommended action other than acceptance by the Finance Committee of this report. That concludes the presentation. Thank you.
Do we have any members of the public who want to speak?
Chair, we do not have any requests to
Okay.
speak.
Questions and comments?
I just have one from a first-time Finance Committee member. As I'm learning, let me get back to the beginning here. So in the executive summary, it talks about 164 million has been collected through the end of Q3, which is 66.2% of the adjusted budget, and 180 million spent, 63.1% of the adjusted budget. Is that typical? I note that we're 75% of the way through the fiscal year, and these are, in the 60s, but yet they line up together. So could you just tell me a little bit about, is that typical?
Yes, it is. And this time of year, normally we're cutting off at March. Property taxes aren't due from folks until April, so that revenue comes later. And then with sales tax, they're on about at least 2 to 3 month delay because collection going through CDTFA and then remitting to the city. And then we also get like a cleanup payment like sometime in August for sales tax. So these trends are very typical for this time of year.
Thank you. I wondered if it was sort of cyclical because first I got nervous about the 9% behind, but then I said, oh, well, we're further than that ahead on the expense side. So, okay. I don't think I had other questions. I appreciate both the report and the presentation in clearing this up. So that's all I have at the moment. Thank you.
Ed?
I have one similar question on slide. Oh, I guess they're not. I guess they don't have page numbers, but the general fund expenditure highlights.
3.
Okay. Oh yeah, sorry. Here it is over here. So I know that these are not exactly smooth, but the increases over Q3 in expenses, which, are totaling about 35 million higher, you said was primarily due to salaries and so on. But we don't have a comparison here to what you think Q3 24 budget is. And for salaries, you should be able to have a budget and an actual. And obviously police and fire, for example, is substantially salaries. So I'm sorry, substantially salaries in both years. So I guess the question is, in those two particularly, are we comfortable that whatever's budgeted for those two departments is that we're pretty much on target for that?
I can help with that. In the attachment A, we have a presentation of the adopted budget, the adjusted budget, and then the actuals. So that I think speaks more to the budget versus actuals.
Okay.
And in the affirmative, yes, we're pretty confident that those two operations will come within the adjusted budget.
Yeah, I mean, I know we raised salaries significantly, which I think is a good thing. I just was wondering if we were tracking to budget on those two, so.
Yes, and in this slide, we're showing about 76.6% in police. We're slightly above the 75% target, fire slightly below. So I feel like at end of year, we're going to land right on target for those two departments.
Okay, thanks.
So kind of following up on a similar vein, we've got, we're 9.2% higher than the same quarter last year on revenues, 23.4% higher than on expenses than last year. I don't know whether Q3's, even though it's Q3 to Q3, whether we can make any meaningful assumptions on that basis, but is it pointed out what was the percent increase on an annualized basis for each of those? What was the revenue increase for all the revenue streams and the expenses? And how do those two Q3 to Q3 compare versus what we were projecting on an annualized? Or is that really something that we can draw any tentative conclusions on that basis?
Let me take us a step back. I think we were kind of brief in this point, but in that line that's called other, all other departments, in the agenda report, you'll see we had legal expenses of 1.4 million related to the settlement of Green versus the city, which we had a reserve for already. Plus, we had general expenses for a first set of refunds issued to the active class members related to some previously determined obligations. So the anomaly that we see in that last row is already accounted for. And so if we were to extrapolate, that really wouldn't be kind of a informative
Not in that
exercise.
one.
Yeah.
And the other categories, though, for instance, on the revenue side, the 9.2% higher than the same quarter the previous year. Is that something that we can draw any conclusions on? Okay, I'm seeing Kylie say no.
Sure. So I wouldn't say that it's nothing you can draw conclusions on, but if I'm tracking with the line of questioning of the committee, I suspect when you say draw any conclusions by, and perhaps correct me if I'm wrong, you're thinking about that in terms of, how are we tracking compared to budget this year versus how are we tracking compared to budget at this same time last year?
Well, and what does that mean about what it might be on your end?
Right. So I think your better frame is not so much that 9.2%, because that really, your budget already assumed a year-over-year growth.
But how much? What was it?
Can we take a
On
look
the
at the
revenue.
slide 2 right there? You'll see 247,000 is fiscal 24, and relationally, that's 66%. If you look at the last two columns, fiscal 23's budget was 224 million, and relationally, we were at about 67%. So we're tracking fairly consistently if we wanted to just talk about top line.
And
Right.
year over year revenue increases, what were we projecting for the year end?
Right. We'd have to go look at the budget in terms of what the 2024 budget reflected. But what Director Lai has identified, which is what I think we find most helpful and that prior finance committees have found most helpful, is looking at those last two columns, FY24 adjusted budget and FY23 adjusted budget, and that 66.9 versus 66.2. That's really showing you how are you doing at this point in time, actuals versus what you planned at the same snapshot. So because, right, your budget every year is going to change, your assumptions are going to adjust. And so what those last two numbers, 66.2 and 66.9% show you is how are we doing at this same point in time compared to how we were projecting we would do. Same thing on the expense side, right? And as Director Lai identified on slide 3, we're at 63.1% expended, which is a little bit higher, admittedly, than where we were at this point in time last year compared to what we planned to spend. But we have some anomalies that are happening. And things like the class action suit are kind of lump sum payments as opposed to things that are spread out over equally 1/12, 1/12.
Yeah, it's not a little bit on that one. And
Right.
And the question is how much of that is explained by the anomalies versus is it a pattern?
Right. And so I think what's a better indicator of pattern is really when you look at the departments, which is what I think Director Lai was referencing. When you look at police was at 77.6% expended right now compared to their budget, whereas last year at this time, that same department was at 75.1%. I can tell you right now, one of the reasons why PD is a little bit higher is you're going to see their overtime up because they're doing that retail grant where they've got extra folks that's funded by the grant support. So they have extra patrol, basically. You can kind of see fires trending a little bit higher. Fires doing a lot better on their vacancies. And some are trending, at different points. So that's a better indicator, I think, that you're looking at in terms of departments and how we're doing versus that not all other departments can, have those kind of unique cases.
And the increase in revenue on permits, licenses, and other fees was 2023 an abnormally low year? I'm trying to understand why such a jump there as an indication of other activity, not just concern over or interest in the revenue dollars, but what's that indicating as far as what's happening in the community?
What line item are you referring to again?
This
Claire?
on slide 2, sorry,
Yeah.
and the what, 6th line? Permits, licenses, and other fees.
Yeah, for the, if we compare, the two fiscal year, it is noted that the new construction permit is really high this current fiscal year.
But compared to last year, but
Mhm.
what I'm trying to understand was last year exceptionally low compared to historic, and we're just returning to normal, or are we in a boom year?
What I actually think, finance manager, is the next sentence that's most important, is that these are the gross permits and licenses that have come in for new construction. And at
Mhm.
the end of the year, we adjust it for what the percentage completion is, since they're on a rolling reimbursement basis. So that number actually will likely come down. It's what we call deferred revenue. And that's when and this is why these are unaudited, because those new construction components are, all the money comes in up front and they spend it down over the life of the project. And oftentimes, as you know, construction projects, development is a multi-year process.
Yeah, I'm just surprised. I hadn't had a sense that we were having an increase in construction in the community versus historic. And I'm
Right.
asking myself, is it really up versus historic, or was last year really down?
Well, and I guess what I'm trying to say is these numbers, I wouldn't trust them to be able to tell you that. What would be more informative would be to have the Planning and Development Services Department help us understand volume of permits. And I know they have that data. It's just not necessarily
Okay.
part of this report.
My takeaway is it's tough to conclude anything off Q3.
I think it's stay the course.
Okay. And this is really just to accept the report. If we don't have any other questions, I guess we need to move to accept it. Yeah, I guess so. So moved.
Second.
All right. All in favor? Aye, that passes unanimously.
And Chair,
Yes.
I'll just throw this out, but at some point, we would wonder if this committee would like an informational section on the agenda where we could submit this to the committee without a presentation or discussion. Just wanted to throw that out there. If you receive this or other reports where you may not want a full briefing. So food for thought.
So let's reflect on what our questions were, and we had questions, but we weren't really able to conclude much. What do you think about this being just an informational report going forward, or do we want to agendize it and have the opportunity for questions if they should arise? There might be times where something does leap out and that we really do want to discuss.
And even though we didn't have a lot of questions, we had greater than 0.
Yeah.
And it didn't take
Right.
long, so.
Yeah, let's keep it. That's
Thank you.
thank you. And that takes us to our final item which is continued discussion of the FY25 budget wrap-up and recommended FY25 budget, including the municipal fee schedule.
Thank you, departing staff.
Yes, thanks.
Thank you.
Thanks. Okay, wonderful. Thank you, Chair. So tonight we're bringing this back for consideration of one item and maybe others for the committee to review. We're continuing the budget wrap up from May 21st. So next item, please. We want the committee to consider the option of potentially reducing the real property investment reserve as published in the proposed budget. There's $2.5 million in there. One option would be to reduce it to $1.1 million annually. With that, you could consider offsetting the source side. If you recall, we had like table 1 and table 2, where we have the use of funds, which is the reserve, and then to balance it would be the source side. If you want to offset that reduction of 1.5 million, a couple of options to consider would be to reduce the gas equity transfer. Maybe we don't need 2 million, or reduce our use of general fund uncertainty reserve, or budget stabilization reserve, right? So you may say we want some degree of that gas transfer and we want to preserve general fund reserve. That's what we're saying in the first 2 bullet points. Or you might say, well, we might want to appropriate more in one or more areas, or a combination of all 3. Just would like to share that in a couple of days, we do need to publish the agenda report for June 17th for the full council's consideration of the summarization of the work that's been done by this body. So that's our ask, that if we have a lot of changes tonight, that would really compromise our ability to QC or
I don't
quality
anticipate
check.
a lot.
Oh, that's encouraging. So I'll stop there, Chair, and I'll turn it back to you.
Great. Well, let's see if we have members of the public first.
We do have one request to speak. Our first and only speaker is Jasmine B.
Hello, good evening, members of the Financial Committee. I just would like to thank you so much for your continuing interest and in the United Nations Association Film Festival. I just came actually to give you some updates that UNAV became a member of the Chamber of Commerce. So we're extremely happy because it's obviously connecting us again with the businesses, what we are extremely happy to do. And we have a lot of our sponsors and people who are helping us. So we already had an amazing event with the Chamber of Commerce. So the other Thursday, and also would like to give you the update that I just had an amazing opportunity today to talk with the former U.S. ambassador in the United Nations, Susan Rice. So she was at Stanford. She gave a speech, and after the speech, I had a chance to talk with her about UNAV, and also, of course, which was established here in Palo Alto. So this was an amazing moment again to make some publicity for our efforts. And one small detail that I would like to add is from the yesterday's meeting of the City of Palo Alto Council, talking about 445 Bryan Street. That's a possibility for the collaboration. Would like to thank the members of the council to listening to our ideas to help both the seniors and the teens in this space. And this is something which why we established and why I founded UNAV, to really educate and help both citizens senior citizens, youth, and in general, our citizens. So again, thank you so much for all your support and being such a wonderful group of citizens to moving us forward in the next level, whatever the budget is going to be for you. And we're extremely grateful. So thank you again. Thank you.
Thank you for your comments. Our next speaker is Karen H.
So you never know what you're going to get when you come to a meeting. It gave me a great opportunity to visit with Jasmine. So, so thank you for holding this meeting. As you all know, the museum has made a request, and we appreciate very much your consideration of that request. As you also know, we're in the process of rehabilitating the Roth Building, the City Old facility currently, and we're on schedule still to complete that rehabilitation by the end of the year. We also have some unfunded projects as a part of that project, such as security systems, the remainder of the Arnatov fresco rehabilitation is also outstanding. There are a number of things like that that are not currently funded. We've been spending down the Anna Eshoo sponsored HUD grant, which was really intended for the museum build out in order to keep the project on track, on time, and we've made some compromises of materials and stuff to help facilitate that and to be cost conscious and prudent. We also understand and respect that there are budget constraints that you all are facing, and we very much respect that. So I think at the last meeting there was some conversation about perhaps doing part of the funding for this fiscal year and maybe a part of it next fiscal year. Obviously, it would be most helpful for us if we could have the funding or get the funding, the full funding by end of this calendar year, because we could apply it directly to the rehabilitation project and we could replenish the HUD grant, because we spent it down. We spent 2.3 of the $3 million of the HUD grant. That said, if we could suggest that the $500,000 for this year would still help remarkably in this calendar year and sooner than later to help us finish the rehab of the Roth building, that would be great. And then with latitude in the next fiscal year to apply the other half of the request to the museum build out. That way we could still use, if you will, backfill the HUD grant. And that would still be very, very useful to us, given that latitude. If it's tied the way it is now, that it has to be applied to the Roth rehabilitation, the timing doesn't work at all. Accounts will be closed and the Roth rehabilitation will be completed. So I hope that's clear. It's like, if you can do all of it this fiscal year, outstanding. If you could do half and half, and the second half next fiscal year and be applied to the museum build out, that would be also outstanding and most gratefully appreciated.
As we return to the council, let me just ask a clarifying question on the History Museum. As what we put into the budget was the $500,000 toward the hard shell build, what do we call it? And then it was essentially a staff commitment that an additional $500,000 would subsequently be put in the next year's budget toward the interior build out, we'll call it, or the rehab. No, the nomenclature we've invented for this is confusing sometimes. But is that correct? Is that where we stand?
Thank you for the question. Paul Harper, Office of Management and Budget. So yes, as part of what the committee did for the 25 budget, there was $500,000 added in 2025 to the project with a commitment in future years, and it wasn't really distinguished which year to put an additional $500,000 into the project for additional costs.
Presumably it would be when that next phase occurred, as soon as next year. Yeah, okay, good. Yeah, pardon me?
Chair, I think you said it as soon as that next phase occurs, and you said next year, but I think what you meant is the year after FY25, meaning FY26.
Right,
Yes, okay, just wanted to confirm.
the following fiscal year. Yeah.
So you just said end cost, so that means it's not restricted to the rehab per there. I just want, Mr. Harper, just
So it would be in the project, and I think that would be sort of up to determination whether it would go towards the hard costs or the build out. And I think there would need to be some sort of update of the agreement with the History Museum in terms of what the funding was for.
Well, it's anticipated that the hard shell will be completed this fiscal year, so the
Yeah.
assumption is that it would go to the interior build out.
Right, and interior build out would still be capital costs, to my understanding, whether it's buying FF&E or building interior walls or that kind of thing. And the slight distinction, I think, is we currently have the tenant work letter, as the committee knows, in place. And that tenant work letter is about the first phase, the actual rehabilitation. And so we would amend that tenant work letter for the initial 500,000. The second 500,000, it's an open question whether or not we would even need to amend the tenant work letter or rather transition it to a capital grant. And so I think we have time to figure that piece out. As long as we simply have the direction from the committee, we can work with the museum.
Great.
yeah, I was just confirming that nothing we did restricted it in any way. Great.
Okay. I think that clarifies that. And then we really have the question before us, whether we want to reduce the real property investment reserve down to 1 million. And if so, where to apply it. I'll just leap forward and say my inclination is to apply it to reducing the uncertainty or budget stabilization reserve, so that basically we'd have additional dollars for the following fiscal year. Is that, am I understanding that correctly?
May we have slide 2 up, please? Paul, did you want to respond? I didn't know. Okay. So, Chair, if I heard you correctly, we would maintain the gas tax equity transfer at 2 million from the May 21st direction and take this 1.5 million from the first bullet point and then continue to preserve our uncertainty reserve for the benefit of the general fund.
Yeah, I was basically going to say the exact same thing. But to ask which reserve staff had a preference for, if you had a preference at all.
Yes, we do have a preference. Thank you for the question. I think the idea would be to try to keep the budget stabilization around that 18.5% target and then put the rest in uncertainty reserve, because the uncertainty reserve gives us the most flexibility and the council the most flexibility as we continue to balance the budget and define the service levels and priority projects.
Yeah, and I do think the reason I think it's good to use one of these reserves is it's only $1.5 million. And somewhere in the next 12 months, we're going to have some emergency that's going to need $1.5 million. So I think, having a little bit of room there. Or
I don't assume that. We
could.
if we have I'll just respond to that. We have our mid-year update, and because we try to budget moderately conservatively, we typically have a net improvement in our position at mid-year. There may be some additional expenses, but they're typically coming out of that net improvement as opposed to dipping in to that uncertainty reserve. Time will tell, but I'm not making the assumption that you just described.
Well, I wasn't quite finished. I was going to say, in contrast to bullet point 3, which is to decide to spend $1 million or $1.5 million tonight. That was really my contrast. That's why I like it in the reserves.
I see.
And of course, we have the option of spending less than that and putting the rest in, or, because, so in other words, we have an option of putting some amount in the reserve and spending some. And the reason I raised that is I wanted to lift up to the committee, sorry, been a long 2 days. We obviously talked about that previously here and decided, there was his rep might be more appropriate. We talked about CDBG, but that seemed pretty unlikely. I can't remember the amount of that. I think it was 150.
250.
250. I don't know if there's some amount of that, like, I don't know how good we feel about the HISRAP likelihood, if we wanted to revisit that, maybe parse it, but I did want to lift that up because we did hear a lot about that last
Well,
night.
And I think that's worth considering, but if I'm remembering correctly, had we put that into kind of a parking lot for things we would reconsider at the mid-year update, or was it not included in that?
We didn't have such a list. We had a work plan one where staff was going to continue to analyze and research certain items or pilot it without appropriations. But we didn't have a list that says we'll bring this back at mid-year.
Well, and I think one of the things about Ability Path is we didn't really fully understand what was the urgency, what was the need. It was going to be a matching grant.
And I
Do
think
we understand more of that now?
I don't know that we do, and I think I lifted up the question of when we make these grants, what degree of information do we want about how they're going to spend them? We were talking if they're smaller, maybe we don't need so much. If they're bigger, maybe we need a little more. And I think HISRAP has a pretty robust process for that. I just wanted to lift that back up
That would
because I
be a
do
big
think
nut for his rep though.
exactly.
Yeah, and those funds are competed for by a whole bunch of really meritorious groups.
And that's what worries me is that if we put it toward that then they may be stuck. But I don't think we have a lot of information either. So I'm not really sure how to handle it. My instinct is I'd like to help them in this way, but I don't have enough granular detail on why the 250 or how to parse it.
What did we get any greater depth on their requests than what came to the committee?
Yeah, I believe, and Director Lai is looking, in the supplemental memo, we provided the information on what the request is for. Ultimately, it is, I think, fair to kind of characterize it as startup funds to leverage to help build a donor base for programming. It's not necessary, it's not for, frankly, it's not for CapEx. It is really, since they are going to start operating in a new location, that kind of request.
Right.
Now, I'll just say, they've come forward with this request. There hasn't been a public process. I'm sure there are other agencies that if we said we were going to provide a grant of that size, would also be interested. So I think that's the crux of what the council is kind of grappling with. And you've made headway, I have to say, and I'm appreciative of the committee's direction and recommendation to council on this, the special events program that you've recommended. This year, understanding that we kind of have direct allocations that are planned, but I think the intention of the committee is to build out some sort of process. And I do think we as an organization are going to revisit this whole topic when we come back with the nonprofit relationships and audit recommendations. And so we are expecting to come back to the council in a study session to get general kind of dialogue around these kinds of issues. So it's very timely, but doesn't
Yeah.
solve.
So I really appreciate that reminder on the process considerations, but I don't know that that comes at a time we can give dollars once we figure out the process. And so it sounds like it's not CapEx, but it's also not direct services. So it's sort of in the tween, sort of the fundraising administration. Is that it?
Sure, but I mean, ultimately, the funding would be used for, I think, the
direct
staff to
services.
do the programming, the services and the supplies and materials for
I
it.
will make a comparison to when Magical Bridge got started. We had looked at providing the land for the playground, but they were really asking that the city make a financial contribution that would then be the seed that they would leverage. And I believe we did, I think it was $250,000. It was, I think in 2010, when we were actually in the middle of Great Recession budgetary constraints, and we went forward and did that, which really they attribute that to having been the foundation for moving to becoming what they are today. I'm not saying this is the same thing, but that request for a seed funding that they leveraged had that similarity. I don't know kind of when this is they're looking for this to begin a kind of fundraising program and sort of a matching fund sort of approach, but have they clarified what time frame they were necessarily intending to move forward? Was it as soon as this?
What's in the packet in the supplemental memo is a slide deck from them, really just explaining the mission and the impact that Ability Path can have. And so what Kylie was able to ascertain from them is when we summarized it in the memo itself is, as she mentioned, it's really to try to create some seed funding. So then that could be demonstrated and leveraged for more donors. That's the most we know at this time. And so going back to, I think some of what we've heard right now is, do we want to listen to in August about the nonprofits and then kind of see where the city's fiscal year ends? Because in October-ish, November, you'll get the actuals for the city's fiscal year, June 30th, right? And then have a better assessment.
And then following that, by several months, we would do maybe January or February, the mid-year budget
Correct.
update, which is when we might take additional actions.
Yes.
That sounds like a good scenario to me.
Yeah, I agree. And what's nice is if it's seed funding, it's not like, sometimes there's requests for funding that if you fund half of it, it doesn't do them any good. But if it's seed funding for matching or growing others, an interim amount could. So if we could look at that, if there's some way to peg it now to look at it at the mid-year budget review, I would
Yeah, we
support
certainly
that.
could include that as one of the items that we are tentatively planning on looking at again at mid-year budget.
Noted.
So,
Yeah, I think that's good timing. I think just, excuse me, it brings up the subject as we discussed it last time, but, you know, we as a committee and the council, we can't just act on everybody that asks for money. It's just that simple. And particularly when they ask for $250,000. And the process here has been a bit flawed and, you know, we're still working to figure out what is it you want, what you're going to do with it. And that should really be their responsibility to make it very clear to us. So I think, and it's shifted. I mean, originally it was supposed to be internal construction design, which I didn't think was appropriate at all. And now it's more like programming. Well, maybe that's better. But I don't see that we should take action on this now. And I think we have contributed to this category, which I think is very important, of disabled in a number of ways, including Magical Bridge and I'm just pointing that on the brand, the wonderful where they sell cookies and give food. Ada's. I'm there all the time and I can't even say the name. So I think it is important that the city contribute in all the categories of need. And of course, we're contributing through his rap to, you know, quite a lot of them. So I think that's important and we are on the record to do that and we can probably do more, but we just have to, you know, manage this thing in a reasonable way.
I agree that we shouldn't act on it tonight, and I'm glad we're going to have this process conversation, because I also think that it's more than just a category. If there's a group that's built up, you know, decades of work, we don't want to, you know, lose that infrastructure. So I do appreciate that they've been contributing to the community for a while, but I agree with you. Let's get a process. Let's look at it at a later date.
Okay. So on that note, I would move that we essentially transfer the 1.5 million less in real property investment reserve to the uncertainty reserve.
Can we confirm if that's a one-time or an ongoing action?
Oh, yeah, I would say for the time being, it would be, I'm thinking it'd be the ongoing. What do we have projected going forward in that real property investment reserve? I guess I'm not clear on that.
We have 2.5 million budgeted every year going forward for that reserve.
But
Yeah, I think
we're only
so.
presenting the 25 budget
Yeah. I
next week, so.
think this is
maybe
what
it
we were trying to clarify in our prior discussion.
Yeah, but it would go into long-range financial forecast.
So you could split the difference there and say we should have it in this one and the next one. I'm sorry, not have it in this one or the next one. And then take a look at it after that. Or I mean, go ahead and
Well,
project.
but it's there going forward. And if it was a property investment that might be paid for by a bond measure going forward, then it doesn't come out of the budget there. This is a placeholder that is very much just trying to make sure that we have something that is roughly our anticipated needs without having to find them.
Maybe we just pull it for now.
Going forward. So we leave 1
Ongoing.
million in annually going forward.
Ongoing.
Yeah.
Mhm.
Ongoing.
Yes.
Yeah.
That clears.
Okay. So that's the motion. That's your second? Great. Any other discussion? All in favor? All right. All right.
Just want to
Yes.
confirm also the direction would be the BSR at 18.5, and then we'll take the difference in preserving the uncertainty reserve.
That's correct.
Thank you.
Okay. The future meetings?
June next year.
Second.
Well, I have to say, committee, you have moved through a lot of material in these first 6 months. Your next June meeting has been canceled because you will be having a council meeting that evening. That's your reward. So the next time that we will be meeting is going to be after the council's summer recess, and so that will be in August.
And do we have any tentative agendas
Right.
or items?
Director Lai?
That's the his wrap one coming back, where we're going to look at the human services contracts and nonprofits and bring that information back to you, and also talk a bit about the process.
So is that August 6th? August 6th, I see. Okay, great. Too late to move that we do have the finance committee meeting instead of the council meeting?
Great. On that note, the meeting's adjourned.